Good morning. Preparing to call the Defined Contribution Committee to order, but not quite doing it yet.
Well, you're close.
I wanted to give Ray an opportunity to say a few words first.
Thank you, Mr. Chairman. Well, good morning, and it's great to see everyone as we get started. Just as a reminder, we will be live streaming today for the first time, so keep that in mind. And if you would, please, when speaking, speak directly into the microphone. That'll help with hearing and everyone being able to hear the information. And by the same token, if you're not intending to speak, keep in mind that the microphones are fairly sensitive, especially in feeding into the online system or the electronic system, so keep that in mind. And unless you all have any questions, I'm going to ask the team to turn us on and get us started, and then you can officially call it to order.
Now, we will officially call the Defined Contribution Committee meeting to order. Live streaming is on now, I think, so I'll turn it over for the performance review.
Good morning, Mr. Chairman. I am going to turn the microphone over to Mr. Ford and let him give you a performance review of the deferred compensation plan and the optional retirement plan. Mr. Ford?
Great. Thank you, Charles. Good morning, trustees. Good to see everyone. Mr. Executive Director, hope everyone's having a great summer. We're pleased to be back here in Jackson with you all today. So for the first item, we are going to review the MDC now through the end of June 30th. That is in its own book that you should hopefully have before you. And we will jump just behind the cover to a couple pages in that has the capital markets review. All the boxes are right on the page there. It should say page 1 in the bottom. We're just going to set the stage for what's been going on in the market and economic environment. This is important because it kind of informs our read of the performance of the MDC investment options. It really provides the context for the results that we'll see momentarily. So just broad strokes, for the first half of 2024, we saw continued strong performance from U.S. stock markets. So the S&P 500, remember that's a collection of larger companies, gained 11% in the first quarter and an additional 4% in the second quarter. And it, along the way, hit 31 new record highs. Taking all that together, the index is up a lofty 24.6% for the trailing year through June 30th. So it's continued to really power growth across participant accounts. As we'll see when we look at the defined benefit plan momentarily, the run of positive stock market performance continued after the end of the quarter through July and into August as we close in on the end of the month. Outside the U.S., now if you look on the right side of the page and we have some returns for the various market indices, equity markets abroad saw much more modest increases. Outside the U.S., they're struggling more with uncertainty around future economic growth, and that translated into some more muted economic market performance. And meanwhile, fixed income markets have really been anticipating what the Fed is going to do and the future path of interest rates. So investors are looking for guidance from Fed Chair Jerome Powell, but also reading economic signals like inflation and jobs reports. Now, the Bloomberg U.S. aggregate, that's a proxy for the broad bond market, was up only very slightly, plus 0.1% positive for the quarter, and 2.6% for the trailing year. Now, all that's happened as yields have bounced around up and down and been quite volatile, as investors await future certainty from where rates are headed. So that's what's really been driving the capital markets. A few other broad macro themes that we just wanted to talk to you about and that we'll hear more about in the DB review include index concentration within equity markets. Now, this is going to be important when we look at performance in a moment, but whether it's the S&P 500 or large cap growth stocks, really only a handful of names is what's driving return there. So when we look at the index level, it's a little bit deceiving because not all of the stocks are performing as well as that may indicate. And no surprise, it's most often the tech companies or those with any association to AI that have really dominated the landscape this year. And then the only other big theme that we'll touch on is we are now on the precipice of a first of a series of rate cuts. And this is for the first time since March 2020 that we're facing this prospect. Inflation has finally notched below 3% for the first time in almost 3.5 years and is heading towards the Fed's target of 2%. That will finally enable the Fed to lower policy rates starting as early as September. So those are really kind of the broad factors that continue to drive markets. The intervening pages have a lot more depth, but we're going to push ahead and look at the results of the MDC itself, unless there are any questions. Okay, hearing none, if you would all jump ahead to page 18, and we'll take a look at the actual asset allocation. As we typically review, the plan structure here provides participants 8 main asset classes, so, well arrayed across equities, bonds, and all of the building blocks necessary to create a diversified investment strategy. Additionally, at the bottom of the page, you'll see the deferred comp, the self-directed brokerage window offered via Schwab. That's a relatively new addition to the MDC. Hasn't had a lot of uptake across participants yet, but is starting to garner a small amount of assets. As is, commonly the story with the MDC, domestic equity holds the vast majority of the assets, approximately $1.26 billion, or over half of all of the dollars in the MDC plan. Owing both to the strong performance of equity markets over the last decade plus, but also participant inflows into that space. And of course, a strong 2023 and start to 2024 has really helped continue to bolster values there. Now, the next largest option is principal protected. That's the stable value offering in the plan that holds an additional 21% of MDC assets. And we'll talk a little bit about that more in a moment. But all told, you can see at the bottom of the page, the MDC was up to $2.34 billion at the end of June. And on the next page, 19, we'll see how that unfolded over the period, relatively short period. We're looking at 1 quarter. But you can see the investment return column was largely positive in the black across most of the asset classes and investment options. A little bit of red in those strategies that were investing in smaller companies, which have been a little more challenged. So that indicated some unrealized investment loss there, but largely a very positive picture. Offset to some degree by cash outflows in aggregate. You'll see at the bottom of the page the net new investment column, as is common, reflecting money flowing out of the plan into retirees to fund retirement income. So all told, the investment return plus the cash outflows saw a very modest increase in value, about $10 million over the course of the quarter. And on the next 2 pages, we'll take a look at performance. So on pages 20 and 21, a high-level overview of performance, looking at the trailing returns over various periods. Now, just as a refresher, the way to read this, there's a lot of data on the pages, but for each of the asset classes, the top line are the realized results of that fund. The next line down is the respective benchmark for that strategy. And then below that is the median of the peer group. So that's kind of the secondary lens. We sometimes refer to that as the opportunity cost benchmark. If you weren't in that specific fund, what did the average of the marketplace do? And something else you could have potentially invested yourself in. And then the small numbers to the right are the percentile rankings. So 1 being the best, 100 really being kind of at the bottom of the group. Just a couple of themes that we wanted to tease out and really look at are the funds meeting their objectives is first, stable value at the top. You'll notice that the MDC stable value option over the quarter, last year, and last 3 years has had a hard time beating its benchmark, which is a cash benchmark. And just below that has had a hard time keeping up with money market. That is not something that you would expect over the long run. Stable value does offer a premium over cash, but given the inverted yield curve shape that we've discussed, and you'll see again when we talk about the DB plan, the highest yields are in the shortest maturities, and that is cash. So the cash accounts have been the best performer in this brief economic environment. I mentioned we're now expecting a series of cuts. As the yield curve returns to a more normal shape, the expectation is that stable value will again retain the leadership in terms of performance going forward. So nothing is inherently broken with the strategy. These are not results you would normally expect to see, but really driven by the market environment today, specifically by the rate yield curve environment.
Question.
Go ahead.
Did I misunderstand it? I thought our investments in real estate was gonna go down. An awful lot of red numbers by the real estate at the bottom.
Yes. So these are listed real estate securities, different from the real estate investments that you have in the DB plan, which are direct investments in buildings. They trade like equities on an exchange. They have repriced much more quickly than the core real estate offerings in the DB plan. But they still are facing headwinds, so that, you still are not out of the woods. So there is some negative return for the quarter, and even in fact over the last 3
You
years.
anticipate real estate to change?
In what we're looking at and in talking to managers, the hope is that we are starting to bottom, right? You're seeing the write-downs lessen, and the negative total returns kind of decrease in terms of their magnitude. They are still negative. We still may have another quarter of two of write-downs, but the kind of hope is that we're almost out of that. Another thing that's going to really benefit and enable that, well, two things. The increasing interest rates will really be a benefit to the real estate market. And also the transaction market has kind of returned to life, is thawing a bit, so that people are able to now buy and sell properties. There's price discovery back in the market. So that trend, if it continues, should help in the trajectory of the real estate market.
One correction, the reduction in rates as
The
opposed
what?
to an increase in rates.
Yeah, yep.
The reduction in rates is going to contribute to real estate being more attractive.
Good, thank you.
Yep. And that, I mean, Powell has indicated that's, at this point, all but a foregone conclusion when they meet next in September. First rate cut, and then the expectation is a series of those to follow. So that should bode well for real estate and other asset classes. Moving down, we just like to look at the domestic equity section. This holds a lot of participant assets, and we'll contrast Vanguard Windsor, below that Loomis Sales large cap growth. Two different strategies that lean into different parts of the market, value versus growth. Particularly those with growth have thrown off the biggest returns. You'll see Loomis, 28.7% for the last year, but it's a bit shy of the benchmark right below it at 33.48. And if you go out over longer periods, you'll notice that continues for the last 3 and 5 years. Now, why is that? That's its primary objective. We want it to beat its benchmark. But we go back to that concept of index concentration. The benchmark has become so dominated in a handful of names that active managers have had a really hard time, keeping up. And they're inherently more diversified, and have additional names that, when the market is running in one direction, are a bit of a headwind. And that becomes evident when you look at the little numbers next to the Russell 1000 Growth Index. So over the last 3 years, 4th percentile. Over the last 5 years, 8th percentile. It was an incredibly difficult market space to add value in. Very, very few, if any, managers actually managed to outperform in that environment. And so this is where this lens becomes very important, because it gives us a way to understand the results we're seeing out of this particular manager. They're falling a little bit short of benchmark, but we know why. It's because the market is overly concentrated, not something that we expect to persist forever. And so given that context, we think the results do look solid and in line with expectations. Those are the big comments we wanted to make about performance. For the core options on page 21, the target date funds are performing in line with expectations. You notice that you start at the top of the page, returns are less and grow as you move to the bottom of the page. That's because these follow a glide path. Those at the top are nearest retirement. Those at the bottom are farthest away. They have much more equity and risk in their portfolios that is translating into greater returns. So these are functioning as designed over near and long term. We'll wrap up on page 22 and take a look at fees. So this is a very important fiduciary lever that you control, oversight of the MDC. the takeaway at the bottom of the page, the aggregate asset-weighted expense ratio for the MDC, you'll see bottom row, 0.26%. Now that sounds low, but you compare it to what the median expense ratio is, one column over at 0.83, that confirms it is indeed a very cost-effective implementation. And we like to kind of translate this into dollars, and what that means is that every year, based on the current cost of the investment options and the way they're allocated to, participants save an additional $13 million that instead of being paid out to investment managers through the expense ratios is kept in their accounts, compounds over time, and translates into bigger account balances at the end of the road. So that's a great feature of the MDC. So we're going to stop there. That concludes our review of the MDC. Happy to answer any questions that the committee may have before we look at the ORP.
ORP.
Okay, great. And now we will switch books. It's a slightly thinner book with the optional retirement plan, and dive right in to page 2 and take a look at the allocations across the 3 providers. So you'll notice Corebridge, Voya, and TIA. The splits remain fairly constant, through time, with TIA being the biggest at over 50% of the overall ORP assets. For the end of the second quarter, just shy of $2 billion in total ORP assets, and that's up from approximately $1.7 billion a year ago. So healthy growth over the course of the last year, again, driven by mostly the equities that we've discussed. If we jump ahead now, and we'll just quickly check on each of the providers. Corebridge on page 10. And this asset distribution table is a nice way to just peer in on all the different options available. So 15 mutual fund options plus a target date series, not too different in structure from the MDC. Domestic equity within the Corebridge is the largest asset class at about a 26% of assets, and that's followed by target date at 18. You'll see that they ended the quarter roughly flat. So although there was nice investment return in aggregate, that was effectively matched by cash outflows, such that the total combined assets in the Corebridge platform remained, pretty close to where they started. Much like we reviewed with the MDC plan on page 11, the performance of the investment options follows similar themes. Yields being highest on the short end of the curve have really benefited cash relative to other fixed income and particularly stable value. And then those investment options that leaned into growth names, tech names, and those associated with AI did the best. So that is very similar to the themes we saw within the MDC. And now we'll take a look at Voya very quick on page 23. So similar in concept to, wait a second, excuse me, I missed a page here. 21, I'm sorry, for Voya. Similar idea in that it offers 15 mutual fund options. A difference relative to Corebridge is the target date maturity. So this is offered via T. Rowe Price, has an active management component, whereas the Vanguard offering is fully passive, and has a more risk-on glide path, we would call it, higher equity exposure along the life from near retirement to just starting out. That translates into higher short-term volatility, but also potentially larger returns over the long run. And as we've seen, equity markets have done so well over the last couple of years, and certainly over the last 10 years, participants who are invested in these target date funds will have enjoyed that, will have seen relatively comparatively larger balances in their accounts. And so that's a differentiating feature when we talk about Voya relative to Corebridge. And then we'll conclude with TIA on page 27. 18 options, so a few more asset classes relative to Corbridge and Voya. Well diversified across the different asset classes. You'll notice at the bottom of the page, total assets at over 1 billion. So this is really the behemoth of the overall ORP relative to the other providers. Now, unlike AIG, Corbridge and Voya, target date series within this platform is the biggest holder of participant assets. And then one other differentiating feature of this platform is if you look on page 29 at the bottom, TIA real estate. So whereas before we talked about in the MDC REITs, listed real estate securities that trade much like equities, this is a investment option that offers participants direct real estate ownership akin to what you have in the DB plan. So up until the recent cycle, that had been a very nice feature, a very nice offering. Performance, as we have discussed over the last several meetings, remains challenged. And you'll notice that in the trailing results. However, one good feature about this is that the income generation has remained positive and strong. So for those who need an income component, this type of strategy has been able to offer that despite the write down in the value of properties up to this point. But all told, when we look at either the MDC or the ORP, both in terms of how they're being utilized and the performance results, things look very sound within expectations and continue to do well for participants despite this challenging environment we've had over the last couple of years with high volatility and inflation. So we'll stop there and happy to answer any questions that the committee may have.
Any questions before we move on to the investment policy reviews? Thank you all.
All right, the next item on the agenda is the investment policy review for the deferred compensation program. Not any major updates being made. A couple that I'd like to point out is that I did make a change under item number 2, removed the language saying consistent with modern portfolio theory to change to meet their own unique retirement needs. The reason for that is that this is a self-directed program and we can't control whether they are actually taking the steps to make sure that it is consistent with modern portfolio theory. So I made a slight change there. Added, and then towards the end, just to make congruent with consultant reporting, updated the names of the benchmarking for peer grouping. And that is basically all of the changes for MDC.
Do you want to take these up together?
I'm going to take them up together if that's okay with you.
That's fine, sure.
Okay. And then the next one is the policy statement review of the optional retirement plan. In my review of this, I could not find anything that really needed any changing at the time. So the only changes there are dates. And unless there are any questions on these two policy statements, I'm requesting that you approve the changes, updates to the deferred compensation policy and approve the review of the optional retirement plan policy statements.
Is there a motion to accept the staff recommendation for the updates to the deferred comp and ORP investment policies?
I so move.
Is there a second?
Second.
All those in favor say aye.
Aye.
Any opposed?
All right, the next item on the agenda is our representatives from Empower here to give their fiscal year review of the MDC plan. Shannon and Mary Beth. Please help me with Dalvin and Rich Massengill are here to present.
welcome.
Good morning, Chair Rutledge and the board. Thanks for the opportunity to present before you guys this morning. And it's always a pleasure to come and talk about MDC every year. And of course, we appreciate the soon-to-be decade partnership that we have with all of you. We're going to be, going from the booklet, so hopefully you have a copy of it in front of you there. I'll call out the page number that I'm on to help those that may be, moving slides virtually. So I'm going to start on page 3 of the booklet. The title at the top is Introduction, and the one point that I want to point out on this slide, from a benchmarking standpoint, if wherever there is a reference to a benchmark, you guys, or this plan is being compared to 40 other governmental retirement plans or 457 plans that are greater than $500 million. That's the last line that you see at the bottom of page 3. Moving forward to page 4, just to piggyback on some of the remarks that Callan said a second ago, the plan assets right now a little over $2.3 billion. And as you can see, there's an upward trend there year over year since 2021. Looking at the participants with a balance, that trend is a little bit down year over year to the tune of about 1.2%. There are a couple of reasons for that. I just want to share some of the factual comments or thoughts around that. The plan itself is pretty mature, as most of you in the room know. The number of participants that are age 50 or older that have a balance in deferred comp through the end of fiscal year this year, 2024, totals 22,990. That's 61.3% of all accounts with a balance. That number last year was 23,112, which at that time was 60.8%. So a slight uptick in the total number, slight downtick in the total number of folks that are 50 or older, but nonetheless a pretty significant portion of the population. And those folks are taking money out of the plan. At the rate that we're adding participants to the plan, it's being sort of outpaced by the distribution activity. And Rich will touch on the enrollments here in just a second, but I wanted to give some context to that decrease in number. Of course, our goal is to continue to do all employer outreach to not only keep those folks that are age 50 or anyone for that matter that have a balance in the plan, while simultaneously looking at ways to continue to outreach and reach out to those folks that are under 50, those newer employees in the plan as well. If you go to the next slide, slide 5, what I want to point out here, starting on the left, is that the average account balance is also increasing year over year. That's a positive result for all the reasons mentioned by Callan a moment ago with the equity markets and the like. There is a slight variance this plan compared to the other 40 that are on our record keeping system. The average account balance is about 14% or so less, but nonetheless a pretty positive result. To illustrate or to give a little bit more color to a comment that Callan made a moment ago on the far right, you see the allocation by asset class, and as mentioned, the equity funds in the plan outpace all other asset classes within the plan. Moving to slide 6. When I present this slide, I really highlight a couple of things. One, what sort of jumps off the page is something I mentioned a moment ago. Distribution activity is outpacing contributions into the plan. That's not necessarily a bad thing. It just suggests the maturity of the plan. If you look at the very bottom line, the change in value, it does show that at the very highest level, the plan level, that the plan is certainly performing quite well. The last thing that I'll point out positively, and this is a question that some of you may have, if you look at the contributions going into the plan year over year from 23 to 24, that was a $4.26 million positive increase in contributions coming into the plan, or 6.5%. You move forward to the next slide. I just want to highlight a couple of things. Sort of those, you notice like a little bit of a barbell in July of 2023, and then in June of 2024, you'll see that other column, which indicates roll-ins, or transfers into the plan. That is pretty typical as we see a significant number of PLSO activity coming from the DB plan into the deferred comp plan. So that accounts for those increases. And I'm going to take a moment to pause to say this too. From a contribution standpoint, we will appreciate all support that you guys can render to get the Roth addition added to the plan in this upcoming legislative year. For obvious reasons, but for those that don't know, if we don't get that over the finish line, there's a chance we may have to suspend catch-up contributions within the plan. So it's a pretty big deal. So I wanted to put that out there. On the next slide, slide 8, the one thing that I want to call out here, and it goes to what I mentioned a moment ago, we had a little over 2,000 folks that had a balance at the end of fiscal year 2023 that did not have a balance at the end of fiscal year 2024. And the way that breaks out is that it's 131 of those were folks who had maybe predeceased in fiscal year 2023 and their beneficiaries claimed their money, or died in 2023 and their beneficiaries claimed their money. There was 169 folks that had pretty small account balances under $50. Those balances went away, which leaves 1,817 distributions from the plan in way of full cash to that participant, or rollovers out of the plan to another retirement plan or an IRA of sorts. And the last thing that I'll point out before handing over to Rich is on page 9. I just want to point out one thing. At the very bottom of the page, you'll see the distribution of account balances. While you don't see dollar amounts associated with each percentage or category there, I just wanted to highlight that very last piece, the number of accounts that are over $250,000. That 5% is an important 5%. That accounts for 1,932 accounts, a little over $1 billion. And the average account balance for that group is $551,000. So again, that 50-plus group that I mentioned, that they make up the lion's share of those account balances for sure. So it's a pretty top-heavy plan. I'm going to pause there and hand it over to Rich to give you guys an update on participant engagement.
All right, good morning. Again, my name is Rich Massengill. I'm the Director of Participant Engagement. I lead the team of advisors that are out in the field meeting with participants every day. So I really want to just talk a little bit about what we look at from the advisor perspective, thinking about the investment strategy that we're seeing participants use, kind of how our focus is within the do-it-yourself type investor. And then I want to talk a little bit about the results that we saw over the fiscal year. So if we go to the section under participant engagement update, we'll start with the first slide, which is really a little deeper dive than what Shannon had went into with the investment strategy utilization. So if you think about how we look at investors, we really try to bucket them into 3 different buckets. The do-it-yourself investor, the help me do it, or the do it for me, right? And when we think about the do-it-yourself investor, they're not using any kind of allocation tool or potentially using multiple target date funds. So on paper, it appears they're misallocated, right? So we're looking at a do-it-yourself investor not using any allocation tools. Help me do it's going to be your target date fund, or you do have a feature on your plan, a one-time rebalance or implementation through the website where they can get a custom portfolio, implement it one time for free, but there's no ongoing adjustments. They got to be a little bit more engaged. They want a little bit of help. And then lastly is the do it for me, the My Total Retirement, the fee for service managed account service. So when we look at kind of where folks are falling, we can see, of course, that the bulk of the participant populations is still hitting that do-it-yourself type of category. If we go on to, we'll skip 19. If we want to go into 20 real quick, we do like to look at who's using the advisory services, the My Total Retirement program. You can see we've got about 10% of the plan currently using that program. Real important to understand that that is an actionable item that a participant needs to take to enroll, whether it's through an advisor or through the website. When they meet with our advisors, I'll show you kind of our conversation framework here in just a minute, but it's real important that that's a comprehensive conversation, right? If someone's going to use that service and it's going to build a custom allocation for them, there's going to be a fee for that. We need to make sure we've got data like their PERS, estimates in there, like their Social Security estimates, other investable assets to consider that overall mix of how they invest. So we always like to kind of pay attention to that, see how people are using it, and understand that folks can kind of come and go out of that program if they need to. If we continue on to, we'll go to slide 22. You know, I talk about the do-it-yourself investors, and one thing that we always like to do is just kind of compare an overall population against the typical glide path. And as we look at this and we look at all the participants across the plan, every dot on this chart represents a participant. Obviously, the dots are growing as we find folks in more of the same categories. And you'll notice across the bottom, when we look at typical glide paths of either within 10% or even within 20%, of course, the My Total Retirement and the target dates typically keep people in an appropriate glide path. As we move down and we see the do-it-yourself investors, that's the other concern as we think about advisors meeting and kind of prioritizing the types of participants they're meeting with, is the do-it-yourself investors are also the ones that tend to be the farthest from a typical glide path, right? So one of those things that's not right or wrong, and we've talked about this before when we talk about the types of conversations we have, but it warrants a conversation to say, does this fit your overall approach to investing or your retirement plan? We want to continue on to 25. So we take the do-it-yourself investors, and we do look at them in kind of two different buckets. One is those folks that we consider have high equity exposure. So particularly looking at individuals over 50. So we take the do-it-yourself investors. We then say, okay, any of those folks over the age of 50, that's where that 18,415, as Shannon was talking about earlier, right? The population of this plan is certainly maturing. Within that, we do see that about 48% are meeting what we would consider high equity exposure. So generally speaking, they're over 75% equity in their account. Again, one of those things that we just like to be aware of that and understand, okay, there's communications that make sense to go out to these folks, to meet with an advisor, have that free consultation that's offered with this plan, and see is that aligned with what you're trying to achieve? Because the concern is an individual doesn't do those types of reviews. Fast forward, 55, 60, 65, they haven't started to take away some equity risk, and all of a sudden they're starting to use their money while that money is fluctuating with a very volatile market potentially. So something we always like to focus in on is really understanding why that individual is hitting that trigger and doesn't make sense. The next slide is just the flip side of that, right? There's a component of, generally speaking, too much equity exposure, and there's a general component of not enough equity exposure. And so we look at the flip side of that as well. We heard about the stable value fund earlier as well. That tends to be where a lot of folks are going for obviously safety or low risk. But we do tend to see in the do-it-yourself investor side that they can be overweight in that type of holding. That'll get them into this trigger, which we can then drive communications out, have our advisors do proactive outreach to those individuals to try and have that consultation with them. So what I'll do now is I'd like to go to slide 28. Again, I talked about the 5 advisors we have across the field, and I think one of the things that really differentiates how we really try to support this plan is those advisors are in the communities that they're serving, which we love, right? They're part of the groups in their community. They're actually serving those individuals. They know all the aspects of the plan. I would argue they know PERS very, very well, and they're able to have that deep dive type of conversation around how is the deferred comp plan going to supplement or help how you're looking for PERS and certainly how you're looking for Social Security. We do encourage them to do proactive outreach. I talked about those different indicators. We have the ability of looking through the participant data, seeing those indicators, and sending out emails or phone calls or making sure when we're going out on site that our agency or HR contacts are promoting the fact that our advisors can do those free types of consultations, and these folks might benefit from that consultation. The last thing we do is we absolutely believe advice at the center of everything we do, right? What I'll talk about in the metrics here in just a minute is driving outcomes. It's great for us to be available. It's great for us to be able to educate. But at the end of the day, we know that participants are looking for advice. And so we've designed our engagement, how we have those conversations, to really drive outcomes, to give a participant the ability to understand the impact of saving a little bit more, potentially working a little bit longer, or investing a little more appropriate for their goals. If you look at the next slide, you'll see that this is our general framework to how we like to have our conversations. You imagine a participant interaction with one of our advisors. We set up about 45-minute sessions available with our advisors. Obviously, an individual can meet with an advisor as much as they want, but we find that's kind of the sweet spot. You start getting into an hour and a half, 2 hours, kind of eyes start glazing over a little bit. You talk finances that long, right? So 45 minutes is kind of that sweet spot to have that initial conversation and any type of ongoing conversations. And very important that we stick to a framework to get to that idea of what levers can I pull in my financial situation as a participant that's going to improve my outcome. And when we think about the tools that our advisors use and we think about those conversations that we're having, an advisor can meet with an individual and say, based on everything you're doing and the goals you want to attain, you're tracking 50% towards your goals. Did you know if you increase your savings by X, or you work a little bit longer, or we rebalance your account, we can move that to a 70% likelihood or an 80% likelihood, right? And that's going to motivate positive behavior, which is a key component of how we measure success with our advisors meeting out in the field. If we go on to slide 30, we're just looking at fiscal year results. So 4,385 total meetings over the fiscal year supported by 5 advisors out in the field. That constitutes 479 group meetings. You can see that's up year over year. That's 16,985 participants interacted with over the course of the fiscal year. You can see that is up as well. That's 1,590 retirement readiness reviews. That is a conversation that follows that framework that ends with here's the advice, here's our recommendation. That is up year over year. And you see about 2,316 what we call individual meetings. Think of those as more of the education or service meetings. Participants trying to get help navigating the website, understand the withdrawal rules, those types of things. About flat, maybe a little bit lower year over year, which makes sense if we're getting into more conversations focused on advice. Continue to want to see that retirement readiness review number drive up. Obviously, as we think about our partnership with PERS, we're out on PERS on the Moves types of events, full day events. We actually had a great meeting earlier this week where we got the 2 teams together, the education field for PERS and our education team, and just kind of shared what we're seeing out in the field, that type of thing, to really make sure that as we're out there representing the Mississippi Deferred Compensation Plan, our guys are out there also representing PERS and vice versa. The PERS folks are out there representing the value that the Deferred Comp Plan can bring to individuals. Slide 31 is going to be some of those outcomes that we talked about. So we saw a little over 1,900 new plan enrollments, which you can see year over year is certainly up, which we like to see. You think about the types of events that we're going out to. We're certainly going out to new employee orientations, those types of things. Below that, you'll see 1,192. So I talk about measurable results. Those are enrollments that the RPAs, the advisors, supported themselves one-on-one in most cases. So they're able to actually track the number of enrollments that they actually walked a participant through. You can see 855 deferral increases. That's a little bit flat year over year. We were short 1 advisor for maybe 1 quarter of last fiscal year is my expectation that falls into that. We also see 468 diversifications. So I talked about driving advice. And this year, as we're having those retirement readiness reviews, we've enhanced that conversation to include what we call the best interest profile review or best interest standard, where we can provide a recommendation that can either be a target date fund, a free one-time balance, or even a my total retirement based on a participant's responses. We can implement that recommendation. And so you think about diversifications, that's a number of times that a participant said, yeah, it makes sense for me to rebalance my account into what you're recommending. Can you do that for me? And the advisor's actually implementing that for them. Below that, you see 334 personalizations. I expect that number to continue to rise. A personalization is when they meet with someone who's already using the My Total Retirement program, and we're customizing some of those or updating some of those entries. They decide they're going to work a little bit longer. Rarely happens, but maybe that's the case. They want to talk about other outside investments and so on and so forth that they have. And then last 2 slides as I wrap up here. So slide 32, I talk about measuring outcomes. We take all of those outcomes that an advisor can check the box for. We take the number of individual meetings an advisor is having. When a participant meets with one of our advisors, 75% of the time they take a positive action. 75% of the time they make a positive action to their plan to drive more confidence in their retirement. That is significant. That continues to be the encouragement that our advisors in that one-on-one space absolutely make a difference in those participants' lives. And then lastly, you can see the participants' feedback to us, right? We use a Net Promoter Score, which is currently at 84. That is up year over year from a 79. Remember that Net Promoter Score is a scale of -100 to +100. That is beyond world class to have that type of feedback. Our survey tool is built through our appointment tool, so any individual who wants to meet with an advisor can visit the website, can click on the advisor, and it'll go right up against their calendar. They can book a virtual meeting or even an in-person meeting if we're going to be out on site at their location sometime soon. So I will pause there. I think I ran a few minutes over of what I was planning, but certainly if you have any questions on that before I pass it over to Mary Beth.
Okay.
All right, all yours.
Thanks, Rich. And thanks for giving us the opportunity to share an update on some of the key focus areas that Empower is looking at as we go through the next 12, 24 months. So we're going to start behind the Empower Update tab, slide 35. And this is our key focus areas for the next year, year and a half. The first is one that's always on our blueprint, and that's making it easy to do business with us. This is really at the administration level. How do we take the tasks that have to be done on a daily basis and make it easier, make them less steps, take them off of your plate, put them on our plate, and just make it overall easy to do business with. We've got some key things that are in the works this year with regards to enhancing our to-do list functionality and in trying to do more self-serve. We launched what's called the case management system, which allows a tracking for all inquiries that come in from an employer or from a plan sponsor, and they can see where it's at through the process. So always trying to make it easier to do business. Artificial intelligence, I'm going to go into that a little more deeply, so I'm going to put that to the side. But as you're aware, the speed at which artificial intelligence is being leveraged and utilized within all industries has just rapidly increased over the last 18 to 24 months. So want to share an update on that as well as cybersecurity with you. Secure 2.0 has been a major focus for us. This will continue to be a major focus, systems development to support the various features of Secure 2.0. And we'll be doing that through 2028. Most of the provisions will need to be in place with plan document updates and so forth by 2029. And then at the participant level, improving their experience. So over the next few months, there'll be a relaunch of some of the key pages within the participant website to make them more intuitive, to make them more appealing so that people can go in there, find what they're looking to do, and be able to complete their transaction and have positive outcomes. And then finally, as Rich said, advice being at the center of everything we do is critical for us. We know that participants need advice. It's always enhancing our advice tools. This past year, we launched the Best Interest Profile, which has been quite the game changer out in the field. It has really helped people to make good, solid decisions with regards to their account. We'll continue to be making enhancements in that regard. So if you go to the next, actually, we're going to skip a slide and we're going to go to slide 37. One of the things that we launched this year in January of 2024 was an innovation lab. And this was really to support our research around artificial intelligence. This allows us to have an environment that's completely protected from our regular environment where we can test things very quickly and try different things out. It's a test it quick, fail quick, succeed quick, right? Like we want to make sure if we're going to fail on some type of an initiative, we do it quickly, we close that chapter, we move on to the next. So there's a few things that we're really focused on. The first is artificial intelligence, and that's a combination of machine learning, but also knowledge assistance and quantitative insights. It's also data and analytics. As Rich pointed out, we're constantly measuring the things we do, and we're constantly trying to improve. How do we get to the bottom of those analytics and know who to focus on that needs the most help, and how do we track the outcomes that come for it so we can bring that to you? And then finally, new emerging technologies. This field has changed so rapidly that we wanted to have a safe environment for being able to test out different types of technologies and see how does that play into our offering. So safe, bottom line, safe experimentation is what we're looking for. So we'll go to the next page and I'll talk specifically about AI, because I would say this is the #1 thing that most of the plan sponsors that I interact with and most of the commissions and boards are asking about. How are you using AI? So I thought I would bring to you some examples of where we're using AI. But one of the things that I want to absolutely underscore is that we're using artificial intelligence in the most safe way possible. We have a committee that's been put in place that includes regulatory compliance, legal, our technology, our CIO, and then our chief security officer. Anything that's going to be launched will go through that committee first to make sure it's got a full risk assessment. In addition to the committee, having this innovation lab where things could be tested is really beneficial. So I'll share with you some of the things. Actually, I missed one thing. We're practicing a human in the loop approach to it. So we're going to make sure that all of the interactions that we're doing does have a human involved to make sure that these are being deployed in the safest manner possible. So we'll start with the top box here, enhancing one-on-one interactions. So by launching a natural language IVR, we can save about 60 seconds on pre-authentication. That's a game changer, right? Getting people to where they need to get as quickly as possible, but knowing they're fully authenticated helps completely change the experience. We've added enhanced fraud detection, so things like pin drop, being able to test voices, keeping voices of known known fraudulent voices and being able to tap them up against the people that are calling in. So being able to use pin drop. And one of the ones that I like a lot is this live call assessments, agent coaching and support. So whereas every time we would do a review of a call, someone had to listen to all of those calls. But with AI, we're able to deploy technology that can listen and go through a call transcript and say, hey, this is an exceptionally good call. We can go and listen to that call and use it for training purposes. But at the same time, we can look and say, whoop, this one didn't hit some of our key criteria. Pull that one, do one-on-one training with the associate. We can listen to you so many more or evaluate so many more calls by using this type of technology. The other thing is we're able to use AI, deploy it through the website for next best actions for participants. So I think that's a really good one. We've also launched a 24/7 chat box that is able to give participants instant responses to their questions. And we're able to, that next best action, we're able to bring to the mobile experience as well. And then finally, more protection of personal data through the fraud detection, through compliance, making sure that different events are through AI, using that technology to make sure everything's within the compliance guidelines. So lots of great stuff. We're really trying to leverage AI to make our business more efficient, safer, and a better experience for everyone. And then finally, the last thing I just wanted to talk to you about was record keeping in general. We've talked about this before, but as you know, our record keeping system is a modern-based system. It's server-based, it's rules-based, so we set up the plans with your rules at the IRS level, at the plan level, and we can even set rules up at a participant level to make sure that we can maintain our 99.9% quality, right? So all of that's built into the rules. But what I most want to talk about is the efforts that's being put into making sure that the system is secure. We're committed to keep one system, one primary system that we have to protect. That allows us to focus all of our security resources in one spot, which I think is a benefit for you. A lot of time and energy is here, making sure we're patching appropriately, making sure that we're doing the right testing, penetration testing, making sure that we bring in outside expertise and they come and test our system. And we really feel strongly that our program is, top of the line, that we put our security guarantee behind it. So that's the most important part for you. If for any reason one of your participants' accounts is compromised, at no fault of their own, we're going to 100% replace their account for them. And I think that's really important to know. That's all I have. If you have any questions.
Any questions? Thank you all very
Yep.
much.
Yep, yeah, Howard, that's you. Thank you all again for coming. Appreciate the annual update, and we value our partnership with Empower. Just a few questions. On the positive activity rate or positive action rate, I guess an example of that, well, what would be an example of that? I guess increasing your contributions or updating your asset allocation?
Yeah,
Is that-
exactly right, exactly
Okay.
right. So if you think about when an advisor has that meeting, they're able to kind of log the outcomes that they completed with that. And in our meetings, we can do the contribution rate change for the individual, certainly if we're doing it over the phone, where we've got everything kind of documented that way. But, yeah, so it would be a great example would be, hey, I want to increase my contribution, and then maybe that pivots into, hey, I just realized you're sitting 100% in the stable value fund. Do you want to talk about some potential allocation changes and around your goals, that type of thing? So those kind of, those check marks, if you will, are those positive actions.
Sure. And then those, the do-it-yourself investors and those that may have the higher equity exposure over 50, you mentioned how you reach out and of course that may or may not be a good fit for their overall situation, given most of them have access to the defined benefit and Social Security.
Sure.
But just generally speaking, when you do that outreach, what type of response do you get? Do you generally find that they are in an appropriate scenario for their circumstances, or do they generally change something?
So to be honest with you, I think a lot of them don't realize it, right? You think about that individual who originally enrolled, maybe they had someone help them initially when they enrolled into the program, that type of thing. And if you fast forward over 10 years or something, or 20 years, and that equity piece has been growing, right? That they kind of move into that period. So that would be one of the responses we see a lot is, wow, I didn't even realize I was taking that much. Now, to your point, we'll do that review and we may reinforce that to say, hey, based on what you told us you're trying to achieve, even though you're in that space, because you've got so many guaranteed sources of income that accounts for maybe 80 or 90% of your income need, this portfolio might make sense. So I would say a lot of it is a little bit of surprise as far as kind of what that means to their portfolio. And then it would ultimately just be a mixed bag on a one-by-one basis if that diversification actually makes sense at that point.
Sure, sure. And then the last area, just to talk a little bit about legislation, is something you mentioned in the early parts. Tomorrow, we'll have a legislative committee to talk through planning for the upcoming legislative session and any recommendations we have. And subject to the board's discussion and agreement, I suspect that we'll be moving forward again this year with the proposal to include the Roth provisions. So we'll talk through that tomorrow for you to be aware. The last thing I'd mention in that is, once we do move past and finish up some of the legislative priorities and related matters on the PERS DB side, I do hope that we revisit some of the ideas from earlier about legislation around auto enrollment and auto escalation, certainly with the option for the participants to opt out, of course. But it seems to me that if we can get back to that and consider that, that may be a way to ensure everyone knows about the program and to increase participation and grow the program. But with that, I wanted to gather your thoughts on that and maybe what's going on nationally.
I'll let Mary Beth speak about what's going on nationally. I can say categorically it would certainly help with plan participation, and it's something that we can support. I'm unaware of the number of state programs that offer auto enrollment, but we do have a few that do. And to the point, I think the undergird of all of this is just that what we don't know is what each HR function within the various state agencies or political subdivisions. Some take it meaning the deferred comp plan, exposing their employees to the deferred comp plan a little bit more serious than others. That's the part that we sort of are blind to. Rich and his team do a really good job, and of course with Centron's team's help, and getting in there, talking about the entire retirement system. But again, we lose a little track there. So if we went auto enrollment, or even if we had a mechanism where we would mandate, sharing of like employee email addresses and that sort of thing. If it's not full-blown auto enrollment, we have something that we can say, okay, we know what the entire populace is for all state employees and political subdivisions, and we're reaching out to everyone. and right now I can't say confidently that we're doing that, just that, so.
Thank you. Something for the future, maybe.
Yeah, Ray, I would say that recently we've had more and more discussions around auto enrollment and especially the auto escalation component of it, right? There seems to be a lot of interest in making sure that's appropriate and what's the right numbers to put it between. Is it up to, 6%? Is it, whatever that is? So there's been a lot of conversations in that regard. There's been a lot of discussions around, do you implement auto enrollment and then set up a strategy to re-enroll people if they opt out maybe 3 years later and go through that process again when maybe they're in a different financial situation if they've opted out. So it's some interesting strategies to keep that message in front of people. We're in the process of implementing it for a state plan right now. And our biggest discussion was around where do you start it at? Because historically they've started it at a very low dollar amount. And that's why they're really interested in the escalation. They feel more comfortable at a lower amount, but then having the escalation as a part of it. So I think there's just a lot of activity right now.
Thank you. Thank you.
Anything else?
Great,
Thank
thank
you.
Thank
you.
you guys, we appreciate the time.
Thank you.
Miscellaneous updates?
Yes, Mr. Chairman, the only other thing I do have on the agenda is one miscellaneous update. 4 plaintiffs from Northwestern University, Drexel University, University of Arizona, and the University of Michigan have filed a lawsuit against TIA and Morningstar Investment Advisor Services. The plaintiffs claim that TIA and Morningstar were deliberately designing retirement, their retirement options to favor their traditional annuity and real estate account. Also attached is a response from TIA on this matter. I'm not going to make a comment on this. I'm going to let the courts figure this out. I am just letting you know that this is going on. That's all I have.
Any other business for the Defined Contribution Committee? We'll stand adjourned.
Looking forward to going to the investment committee. Do we need to take a short break before the next, or just charge on?
I'd charge on, but it's up to the board.
Charging on.
And as they shift, let me just mention too, one thing that I failed to mention earlier, we do have a couple participants at least online are participating on the phone, and one of whom is Board Member Bill Benson, just for your awareness.
Okay. As the team from Callan is coming up, I'm going to just kind of take us through. A lot of things have happened since the last time we met. For the final quarter of fiscal year 24, U.S. equity markets continue to rally. The Standard & Poor's 500 increased by 4.3%. That return was largely due to the performance of two stocks, NVIDIA and Apple. Collectively, those two stocks accounted for nearly 3/4 of the market's return for the quarter. That's not that healthy. Anyway, for the quarter, the story remained pretty much large cap, or better yet said, mega cap tech or communication services, or nothing. Mid cap, small cap, and developed international markets all detracted. Outside of U.S. large cap equities, the lone bright spot was in emerging markets, which was up 5% for the quarter. Fed fund rates remained at 5.5%. The Bloomberg Ag, which represents intermediate term investment grade bonds, returned 2.63% for the year. The PERS portfolio for the total fixed income portfolio returned 4.93% for the year. It's a big change for what we've been seeing over the last few years. This placed the fixed income portion of the portfolio in the top 21% amongst our peers. Performance came from solid active management and short duration, core, and emerging markets debt. So the PERS portfolio returned 10.78% for the year, placing us near top quartile amongst our peers. Now, for the start of the new fiscal year, July brought about a large turn in U.S. equities, following months of glum performance in small cap stocks, in small caps. Small caps led the return with a 10% return. Even value stocks performed well, returning over 5%. The Standard & Poor 500 only returned 1.2% for the month, as over-the-top earning expectations loomed over those same companies that were singly pushing the index ever higher in the previous months. International developed markets were up 3% for the month, with support from a strong euro and strong yen. The 2- and 10-year Treasury yields fell respectively 46 and 32 basis points, making the yield curve less inverted. Government bond yields across the globe moved lower on lighter inflation numbers and varied econ data. The Fed Reserve left rates unchanged in July, while leaving the door open for a maybe rate cut in September. For the month of July, the PERS portfolio returned 1.63%. So after a great start to a new fiscal year, markets witnessed yet another uptick in negative volatility. As markets weighed whether slowing econ data was a sign of a soft landing or a possible recession. There's some feedback.
Yeah, we've got a little technical issue they're working on.
That
should be good.
That data seemed to, the data that seemed to be most concerning was data released by the Institute of Supply Management, showing that July manufacturing activity contracted at a rate faster than the previous 8 months. Weekly jobless claims jumped to their highest level in the past year, and unemployment rose to 4.3%, the highest level since October 2021. Further aggravating the sell-off that we saw at the start of August was the unwinding of the yen carry trade, following the Bank of Japan's decision to raise interest rates to give the yen support. This forced investors that were participating in this to have to sell stocks into an already down market, putting major pressure across all global financial assets. Now, despite this bout of negative market volatility, markets have recovered with expectations being placed on the Fed to lower rates by a quarter point in September. So far, as of close Monday, October 26th, the portfolio is up almost 3%, with a net assets of $34.67 billion. Now, as I've said in the past, reality has a really funny way of reasserting itself, so don't be surprised if reality does step back in and say hello. We have an uncontrolled spending problem in Congress. We now have a debt service that is greater than what we spend on national defense. If this does not change, don't be surprised if it makes it harder in the future for the Fed to be able to lower interest rates. So that's just me reminding you that reality does still exist. But at this point, I'm going to turn it over to Mr. Jackson and let him take you through their prepared remarks on the PERS portfolio.
Before you do that, if you would, those written comments that you had, interesting. I'd like to peruse those further if you'd make those available for the board members.
Absolutely.
I'd appreciate that. And now, Mr. Jackson, you're on.
Thank you, Mr. Chairman. Good morning, all. Happy to be here today to spend a little bit of time talking about the defined benefit plan.
Excuse me, turn that microphone toward you.
Sorry.
Thank you.
Is that better?
That's better.
Okay. I'm going to be reading from this white executive summary performance review. And I'm going to ask you to turn to page 4. This is the one-page summary that we typically begin with that this is the tearaway sheet if you're going to keep something. We start out with the asset levels. Total fund assets stood at $33.7 billion at the end of June, which was an increase of approximately $118 million from the end of the first quarter. And that represents an increase in the market value of assets of about $385 million and offsetting outflows of $266 million. Overall, asset allocation was in line with targets. The fund returned 1.2% during the second quarter, modestly underperforming the policy benchmark of 1.5. And then for the fiscal year, this is a one-year period, the fund was up 10.8% versus 11.3 for the policy benchmark. Investments in the underlying classes performed as follows. I'm going to touch on the fiscal year returns. Domestic equities were up 21.6%. Now, this was about 1.5% below the benchmark. And what's a little bit atypical here is that large cap is a notoriously difficult place to outperform the benchmark. And the fund was up about 1.7% over its large cap benchmark. Mid and small trailed for this one-year period. And again, an overweight to small versus large contributed to the overall underperformance. International was up about 12.6%. Again, that was ahead of the benchmark by about 1%. Global equity with a 20.7% return was up 2.3% over the benchmark. Fixed income also favorable versus the benchmark, up 4.9%. Real estate trailed, and again, the two soft spots in the portfolio, I guess, would be real estate certainly still in the midst of writing down properties. And while cash flow income is positive, the depreciation of the assets has resulted in negative return. Private equity was up 4.6% for the fiscal year. And then private credit, just recently added, is in its first quarter of performance at 1.8%. So the good news is the benchmark, again, the fund has outperformed the benchmark over 3, 5, 7, 10, and 15-year periods. And over these trailing time periods outside of the 3-year, the fund returned 3.0% for the 3-year period, but the 5-year 8.4, 7, 8.7, 7.7, and 9.8% respectively for those periods. So strong performance overall and a strong fiscal year to be sure. Any questions on that? Okay, let's dive into the details. If you turn to page 5, this is an economic summary. Charles has touched on some of the themes here, and suffice to say that from the equity markets, we saw mixed results, but the overall equity markets rose during the second quarter, extending the strong market performance since 2023. So the S&P 500, again, was up 4.3%. We see that what's contributing to this and what are the headwinds? The GDP, which is the gross domestic product, a measure of the health of the economy, was up 2.8%. Now, this is a surprise in terms of the strength of the economy. This is driven largely by consumer spending. The consumer continues to be resilient. GDP was up 1.4% for the first quarter. So again, we see that the overall health is strong. Headline CPI was at 3.0%. So again, the Fed has been vigilant in its attack on inflation. Last time there was a rate change was July of last year. Expectation at this point, given current events, is that the Fed will step in and cut rates, and that was communicated by Chairman Powell last week, as recently as Friday. Their intention is to cut rates. Now, whether that's at 25 basis points or 50 basis points, again, there's a September meeting, there's a November meeting, and December meeting. So again, the idea here, that coming into the year, there was a survey of the members of the Federal Open Market Committee that sets the rates. The expectation from that survey was that there was going to be 5 to 6 cuts. Well, Lo and behold, market got ahead of itself, and we saw that the inflation was persistent to the point where the Fed has not cut rates yet this year. But that is, that will be changing for the September meeting. We see that the Fed, again, current rates are at 5.25 to 5.50. Unemployment rate, this is kind of interesting. So the Fed has got two mandates, right? Stable prices, and that caused them to make sure that inflation is maintained at a target of approximately 2%. And also stable employment or full employment. Coming into the year, the unemployment number was about at 3.7%. In June, it was 4.1%. And then a report that came out for July indicated that the unemployment rate was 4.3%. So the concern was that, hey, Fed, you've waited too long to cut rates to spur the economy, and now we have an unemployment issue. Market sold off in the first week in August at an extreme level. There was people pounding the table saying that there should be an emergency Fed meeting. Cooler heads prevailed, and suffice to say, when the market was down 3.5% through August 9th, to date, the economy, the S&P 500 is up by 2.5%. So again, earned everything back and then some in the month of August. So, but it was subsequent to that Chairman Powell did state basically that they're going to increase rates and change the direction beginning with September. Any questions on that?
I have a question on the CPI. What's the correlation between the CPI and the inflation rate? Is that the same, or is that?
It is. The CPI is a measure of inflation.
Okay.
So the CPI at 3%, and you'd say the target is 2%. There is another metric out there for inflation. It's the PCE, the personal consumption expenditure. It's a more favored metric for the Fed. That's at 2.5%. But suffice to say, the Fed feels like the inflation concern is abated and likes the path, and it is going to take some time to unwind. Okay. Yep.
Quick question.
Yes.
Some in our state senate have espoused that problems of PERS can be rectified by our continued improvement in investment income. Is that a correct analogy?
I'm going to defer to the work of the actuary in terms of how to meet your obligations to your beneficiaries. But again, it's when I think of the success of an investment program or a benefit program, they're really taking into account, it's not just the market performance, but market performance in conjunction with contributions that are required to meet those benefit obligations.
And I'll add this as well. Investment income is certainly very important, and we had a good investment year this last fiscal year, and that will help. And typically, compared to our peers, we perform well from an investment standpoint. So it's very important, and generally we do well. There's always room to improve, but we have compared favorably. However, I don't think we should think that investments or investment income alone is all that's needed. We need increased contributions and more of a long-term funding plan as well. That's kind of what John, I think, alluded to in the mixed in contributions, but just to add that.
Okay. Let's turn to page 6. And this is just to highlight, to peel back the onion, if you will, of the CPI in terms of, what's contributing to year-over-year inflation. And what's interesting here is that we see that housing is a broad category, including shelters, fuels, heating oil, utilities, and household furnishings. So we see that if you look at that bar to the right, that accounted for 2% of the 3% headline increase over the last year. So again, that was a big driver. there are two metrics that are talked when we mention CPI. There's the core CPI that excludes food and energy. It's used by the Fed for its stability, but suffice to say that the core was actually up 3.3%. And the reason being that, again, when you take the all in, you have gasoline prices actually declined for the 1 year period. So it's actually bringing down inflation. But what's interesting to note is that the housing makes up the bulk of the increase. And what I would say there is that, it's a little bit counterintuitive that you think that, housing sales are down and yet the prices are increasing. The increase in inflation in mortgage rates certainly contributing to that. But again, housing costs, including rents, et cetera, have been on the increase. So to take into account, how do you explain that? The next page just is an indication of this Fed survey that I mentioned. It's referred to as the dot plot, and it's filled out each quarter by members of the Federal Open Market Committee that sets the short-term rates. 19 participants here, again, 7 Fed governors, and then 12 regional presidents. It's kind of a busy chart, but I'm just going to highlight when you look to page 24, that column, you see those 19 dots are hovering around that 4.75 to 5.25. So the median is 5.1% that they anticipate. And this was done in June. Their expectation is the rates were at 5.50 and they're looking at expectations by year end around 5.1. So again, building in. Now they're not communicating anything that the market hasn't. Certainly that the market was building in an inflationary cut. So that early, even before Chairman Powell, but we got still, the market reacts to the headlines and the market bounced immediately after Chairman Powell's comments. With that, let's turn to page 9. And what's highlighted in the orange box is the 1 year returns. And what I'm going to highlight is the S&P 500, again, up 24.5%. And again, one of the themes here is what's going on in the equity markets, and it is concentration. It's the Magnificent Seven. These stocks, both of largely information technology, but built in with AI, have really catapulted the market to 31 new highs, as Alex laid out. Russell 2000 trailing by a significant amount, up only 10%. Now, healthy, we'll take 10% and be very happy with that. But let's look back to the expectations going back to 2023. There was concerns that we were going to have a hard landing, we were going to have a recession, and it seems like the Fed is doing a pretty good job at this point to negotiate that softer landing. Non-US stocks, while positive, up about 11.2%. So that's the MSCI World ex-US. Healthy returns, trailing that of the US markets, and then emerging markets. Again, those are your Chinas, your Indias that really had a big impact in the performance of that, particularly the last quarter where it was up 5%. Those were the two primary contributors. China represents about 25% of that index. So, and then followed by India, which has been a stronger performer, not only just in the past quarter, but over the past year. Real estate, fixed income, again, flat for the quarter as we look at the Bloomberg Ag, up about 2.6%. Fixed income was up another 2.34% in July, up 2% in August. So again, year-to-date performing strongly. Real estate, and the expectation is, as the expectation for rates to come down, the bond pricing is going the other direction. So you're going to see positive returns there. The property index, as you see, the NCREIF property, that's down 5.5%. That's your unlevered private real estate. And the Odyssey, which is your levered, was down about 10%. So again, the real estate markets continue to take their write-downs. The REIT is positive for the year. And again, those are publicly traded real estate stocks that behave more like equities, higher correlation to the equity markets. Cambridge Private Equity, again, this is a collection of private equity funds, and we see that over the last year, it was up about 5.12%. I'm sorry, 5.2%. And again, that's a little bit ahead of PERS private equity performance. So with that, I'm going to go through, this is Trustee Breland's favorite chart. We'll go to page 11. And the takeaway here, this is the S&P 500 valuation measures. And we see that the forward price equity metric is 20.7%. And what is that? That's a metric that tells you how cheap or expensive that particular basket of stocks is. How much is it costing you to buy that, and versus price over earnings? And we see that right now it's at 20.7, the 30-year average is 16.7. So again, the idea there is that right now US stocks are expensive, or more expensive than a lot of their peers, okay? And you see that these bands kind of shows the 30-year average is that bolded green line, and then you've got the dotted line, which is one standard deviation. So that captures like 66% of the observations are within those bands. And we can see that currently the US stocks are trading just outside of that one standard deviation. If we turn to page 12, again, I'm just going to touch on the Magnificent Seven. So these handful of stocks, these 7 stocks comprise 33% of the capitalization of the S&P 500. And in the first 6 months of the year, where the S&P 500 was up 15.2%, this group of 7 had gains of 33%. And the remaining 493 stocks were only up 5%. So it kind of gives you some sense of like, okay, what a big impact this small cohort of stocks really drove the market. And I would say within the Russell 1000 growth, which is a growth-oriented index that has about 48% information technology, again, these group of stocks had a significant effect in terms of how to perform. So when active management, one has a real hard time when they're trying to manage a diversified portfolio when you have stocks like Microsoft that make up 12% of an index, right? So the broad index, again, for the second quarter was the S&P 500, up 4.3%. And value, as I said, the Russell 1000 growth versus value. If you look at the blue bars on the right, you see the Russell 1000 growth is up 8.3% for the quarter, and the value stocks were down 2.2%. And again, that's driven largely because the growth index has about 48% information technology. All right, if you look below, you can kind of see by sector what was positive, what was negative in the winners in this horse race are clearly information technology and communication services. Okay. With that, there's a slide on the Magnificent Seven, but if you just by example, NVIDIA was up 37% for the quarter, Apple 23%, Alphabet 21%, and then Tesla was up 12.6%. So again, these stocks are really driving the market, which is not altogether healthy. What we like to see is a broader recovery. Let's turn to the page 15, which is your non-US stocks. And this is just putting numbers to some of the comments. You can see when you look at the global equity quarterly returns, Japan was down 4.3%. To Charles' point about the Bank of Japan increasing rates, the market reacted strongly by selling off stocks and generating a negative 4.3% stock return. If you look for the quarter, China was up 7%, India up 10.2%. Scan down for the 1-year numbers, and you see that China was down 1.6%. And thus far in the third quarter, they're also down. India was up 34% for the 1-year period. So again, driving a good portion of that index. Fixed income on page 17. Big news here is that, as we're going to see, for this quarter, rates increased. The 10-year Treasury yielding, 4.3%, 4.36 at the end of the quarter. Again, the market action, that's down to 3.85 now. So again, the idea here is that the yields are coming down, the value or the returns going up. Lower quality. So when you think of below investment grade or high yield, if you scan to the right, you see that high yield corporate bonds were up 1.1% over the last year. They were up 10.4%. So generating equity-like returns. And again, these lower quality, why are they doing so well? The idea here is that the Fed is going to cut rates. Funds are going to be more accessible, that they will be able to attack that. Investors are confident. Defaults are at a 1.8%, which is a low compared to historically it's been about 3%. So again, lower defaults, riskier bonds, shorter term, doing very well in this market. And lastly, turning to real estate on page 18. Again, we've got two metrics here. You see the Odyssey, which is the levered benchmark, and you get the NCREIF property index, which is the unlevered. And you see that when you look at the income for each of these, you see that they're generating positive returns on the income front, but the appreciation number is negative. And what's doing well in this particular quarter, if you look down to the bottom, you see the blue bars are the appreciation component and the green are the income component. And again, office being the most punished, and even the darling of the real estate market having some write-downs in industrial. That's performed actually within the real estate components that has, over the last 5 years, has done really well. Office, why is that performing poorly? You know, it's intuitive that when you see that fewer people are going back to work, going back to offices, then you've got supply. And then you have, when rates, when leases are coming up, they're either downsizing or, now the good news is the winners in this particular situation in a smaller market are some of the nicer office spaces. But again, some of those olders where it's a really challenging environment and you've got investors that are not going to put in the money in a shrinking pie type opportunity. So again, that's more of a secular change having impact than necessarily cyclical, where we see the decrease in rates is going to help a lot of other components of the real estate market. Okay. Any questions on the markets? Yes.
John, when you say appreciation on here, that's basically unrealized gains that they're talking about?
Well, it's unrealized losses when it's negative.
Right.
Yeah.
But
Yeah.
they're expecting that appreciation is part of the built-in, along with income, or it could help either keep income up or be a drag on it like it is here.
Yes.
But any of that could happen either way. But they use that appreciation as part of the, part of whether there's a gain or a loss overall.
Yeah. So performance return. So even when you think of stocks, again, the total return on equity securities is you get a dividend payment, that's income, right? So you take that income and then the unrealized portion gives you your total return. So again, it's packaged a little differently, but the concept is the same, whether you're talking about fixed income, whether you're, because in fixed income, certainly, that coupon, the Bloomberg aggregate, which is, as Charles said, a collection of intermediate term fixed income securities investment grade, it's yielding about 5%. But over the last year, the return was 2.4. So what accounts for the difference? It's depreciation or lack of appreciation. Yes.
Thank you.
Okay, let's turn to the portfolio. Page 20. The way to read this is we have the asset classes on the left, the value, and we see that the bottom line value is 33.7 billion. Then we have the percentage of the portfolio. Then we have the target, right? The strategic allocation. And then we see what's the percent different. Are you overweight or underweight versus your strategic allocation? And this is maintained by staff very close to the target. And certainly in extreme cases, you rebalance and you move money, but a very cost-efficient way to do this is when you're making distributions to pull from the overweight class and give to the underweight class, or the underweight class appreciates by the process. So we see domestic equities are actually at this point in time 25.5% versus the target under by about 1.5%. We don't get too finely tuned. 1.5% inside of 2% is certainly well managed in terms of the strategic allocation. 21. So 21, this shows you a cash flow summary. So the way to read this is moving from right to left. We have the earlier market value, and then we have the investment return, and then we have the net new investments. So the net new investments is cash flow. Contributions, distributions, transfers within the asset classes, which will net out to zero. And then we have the ending market value. So you can see that the ending market value is consistent with the page before at 33.7 billion. Net new investments, so these are distributions, net 266 million out. Investment return was 384.7 to the positive, and the beginning value was 33. Over the 1 year period, we started the year July 1st of last year at 32 billion. And the investment return was about 3.3 billion. The distributions were 1.6 billion. So, and that 1.6 billion, the largest amount coming out in the fourth quarter of the last year at $980 million. And again, that's the fourth quarter distributions. So.
118.5 million decrease is a little troublesome, isn't it? Bottom of page 21.
Yeah. So the decrease, so I guess the point there is therein lies the need for contributions to kind of make sure that, as you're going forward, certainly the distributions over the past year at 1.6 billion is a 1 year snapshot, and that will change year to year. When you go through the actuarial exercise, some of these, whether it's people that are passing away, et cetera, that distribution amount is going to change over time. But you're correct in this particular year where, this is a quarter at 118 million, but over the 1 year period, your gains were 3.3 billion. And your distributions were 1.6. So your program earned 1.7 billion over what you paid out. And that includes, again, that's the gain. So
good.
Yeah. All right. Okay. Turning to page 22. So this is the performance summary. There's a lot of information in there for those that are newer to the investment committee. I'm just going to take a moment to say that the key pieces of information here are the total fund, which has a round circle next to it, and that's showing the total fund return. And we see that's broken out in columns showing from the last quarter to the last 15 years. And then you have the policy benchmark. So over the last fiscal year, up 10.78% versus 11.3% for the benchmark. And if you look straight up from there, you see a floating bar chart The numbers next to it is the green one, which is that green triangle. That's in the 21st percentile, and your actual performance was in the 27th percentile. So that's saying when we look at a number of peers, and there's 53 with assets in excess of $10 billion, all right? You outperformed 73% of those funds. So the smaller number is better for the purposes of this chart. And we can see if we look over the last, 5, 7, 10, 15 years, all those returns are in excess, I guess, 7.7% over the last decade, 9.8% over the last 15 years versus the benchmark at 9%. And those returns are, for the 15-year period, you're in the 11th percentile. For the 10-year period, you're in the 21st percentile. And for the last 7 years, 35th percentile. So again, that's outperforming a greater than the majority of your peers. So that's certainly a favorable news. Page 23, this is just showing it by asset class, how well performed. And again, what I would say here is when we look at domestic equities, we're up 21.6% versus benchmark at 23.3. And again, this is where we had this smaller cap underperformance posing a drag in performance. Global equities at 20.7, outperforming its benchmark. International equity at 12.57, outperforming its benchmark. Fixed income 493 versus 263, outperforming its benchmark. Real estate trailing its benchmark. And again, we talked to what's the culprit there is write-downs in office space, and relative to the peers, there's an overweight in JP Morgan. Private equity up for the 1 year period at 4.6% versus a little over 5% for the benchmark. What I would highlight there is that when we look over the 5 year period, private equity was up 15.8%, outperforming the 10.9 for the benchmark. So you see that private equity, even under the last 5 years, at 15.8 versus public equities at 13.8, outperforming, generating a premium. And if we look at longer timeframes, it's even greater. Okay, private credit, new quarter, and then cash. As Charles said, if you look at the 1 year cash at 5.7%, given the way the yield curve is, it's very short term investment, up 5.7% for the 1 year. So that covers the performance, and I would be happy to take any questions.
Any questions of the board?
Thank you.
Director?
There's
Go
There's
ahead.
just one other item I just wanted to wait for the proper time to kind of discuss it. Commissioner Dale had a question about real estate. Real estate was a detractor last year. It was a major detractor. But in our discussions and staff's discussions with our real estate managers, they're starting to see, and they believe that we are either reaching or have reached the trough in write-downs. And with the anticipation of the Fed lightening, interest rates, lowering interest rates, that's kind of starting to initiate discussions for deals to start happening again. So just to kind of give you an idea, and again, 1 month does not make a trend, but last month's performance was very encouraging. Every single part of the real estate portfolio outperformed its relative benchmark in July. REITs outperformed, core real estate outperformed, non-core real estate outperformed. So the total real estate portfolio was up almost 1.4% for the month of July, outperforming its benchmark by about 130 basis points. So that's very positive, and it might be an indication that, the discussions that staff has been having with our real estate managers is true, is that, write-downs are pretty much at the end, and, transactions, are starting to happen again. So I hope that kind of helps answer
But
your question.
doesn't big city office space, since COVID, in a downtrend, and also the decrease in the number of shopping malls over the last 5 years, does either of that have anything to do with anything?
Well, a lot of our asset managers have been, making moves over the last few years to reduce their exposure to non-attractive office space. They have been increasing exposure to top-tier office space, which has been performing very well. And then also, as far as, malls go, a lot of them are focusing on grocery anchored or destination malls, which have been performing exceptional regardless. So we have good asset managers in this space, and the economic indications are kind of churning that things are about to turn around.
Thank you.
Do we have any of our real estate that has not been funded yet? I mean, fully funded for them to be working? And if we do, that money that's not fully funded yet is not truly working for us yet
Right.
as well. Is that a correct assumption, or?
Thorpe, would you mind just 1 second coming up and speaking about?
And come to the microphone, please. Yeah, right there. Yeah, that's a good one.
We do have, on the value add real estate side, it is called over a course of time. Some of those have not been fully funded. They call capital according to when opportunities arise. That usually takes, over the course of the life of the fund, could take 5 years, could take 7 years. Because we do them in sequence, that may take, that they're at different parts of their life cycle, so they have different parts of funding. We do have a significant amount of funds that are completely funded, that are starting to draw down or have drawn down and starting to throw off distributions. So we have in the value add side, we have a little bit of everything as it relates to timing and cycle of their life for the value add real estate. On the core side, they call all of it up front. We do have one fund that has yet to call, and we're expecting them to do so in the next few months.
Good. And as the real estate market, I'm going to say, heats up or begins to turn, then they will call more quickly?
Yes, sir. The transaction markets have been very slow. And when I say transaction markets, that's both buy and sell side. One of the things that we have noticed here recently as it relates to our core real estate is in, I guess it was Q2, ending in June, we actually saw a redemption from all of our core real estate managers. That's the first time we've seen that in over 2 years. So that's positive. So transaction markets are starting to see increased participation.
Questions while we got a real estate expert up there? Okay, thank you. Cool. Any other comments? We can go ahead then, Charles.
Yeah.
Oh,
No, I was gonna say, I did have a couple of comments, but I think just in the interest of time, I'll try to work them in this afternoon.
Okay, very good. Okay, Charles?
The next item on the agenda is the capital market projections. We have Adam Lozinski here with us to cover this. He's been here before. He's a very entertaining presenter covering these topics. And I'm going to hand it over to him.
Thanks, Charles. Maybe as entertaining as you can be when you're covering capital markets. But yeah, it's been a little bit over a year since I've been here. I still recognize a lot of faces. Thanks for having me back. I'll be talking out of the 2024 capital market projections presentation. I'll start on page 4, just kind of talking about our views on this and how we go about this process. In our view, the strategic policy, the investment policy, or the target allocation that you have on the plan is going to be really the key driver of the investment performance of the plan. And so this is an important topic, and so we look at this every year. So even though our projections are long-term in nature and reflect a 10-year horizon, we do update them annually. We try to really anchor to long-term expectations so that you don't have big moves from one year to the next. But we do have to kind of reflect what's gone on in the markets. And we've seen our assumptions change a lot more in the last few years than they typically do, because there was this historic move in interest rates that you're all familiar with and we've talked about. So because of that, our fixed income expectations have moved dramatically. Whereas typically from year to year, you don't see as big of moves in our capital market expectations because they're long-term in nature. Just a couple of, key tenets or some of the philosophies that we use. We use these long-term equilibriums or long-term averages to kind of make sure that we're aligned, not just with an individual asset class, but how they relate to each other. So, we may not be perfect on our expectations for equities and fixed income, but we're a lot more confident that equities are going to outperform fixed income by some degree. And so we look at those relationships. Another thing is that we're really modeling just market beta. So think of that as passive investment. We're not looking at active management here. So to the extent that you employ active management, your returns could be better than what we're projecting here. So that's just a couple of the key things that we think about as we go through this. And then in terms of how we actually develop the assumptions, we use a model for each individual asset class, and then we kind of look at the macro, what's the economy look like, all of those sorts of things to make sure that everything's aligned more broadly. On page 5, just a broad summary of what changed from last year. So, we set these, we're about to start our next process for the next year. Around the third quarter is usually when we start, but we set these once a year. So this is comparing the 2024 assumptions to the 2023. And we raised, equities went up about 25 basis points, so 0.25% on average, whereas fixed income went up by 100 basis points or 1%. So you see how fixed income is moving up much faster because interest rates were rising so fast. So that means that fixed income is still not expected to earn as much as equity, but kind of catching up a little bit, certainly getting more out of that, stabilizing diversification piece than you have in recent years. As far as private markets, we kind of keep that in line with public. So for example, private equity is up about 25 basis points, just like public equities are. And then importantly, we held inflation at 2.5. That was the same number we had last year. The way we think about that is we know inflation is higher right now, so it's been in the mid 3s, as high as 4 when we started this process. But we expect that to come down over this 10-year horizon to something like 2 or 2.25. So over that 10-year period, you average out at around 2.5. Was there a question?
Oh, no, I was just gonna say, I heard an actuary at the meeting we attended say that some of the folks are beginning to look at bumping up that number.
Inflation?
The inflation rate. There's some actuaries out there. So, little.
Actually, I had a discussion with him about that right before this meeting. And
Well, that's good, because I made notes and he saw me making notes about that while we were out there, so.
So we are up from 2.25 in the last couple of years to 2.5. So we've moved ours up a little bit. There were some actuaries or other consulting firms that were closer to 2, and you're starting to see them really move up. So we're at 2.5 flat from last year, but that's up from 2 years ago. Okay, let's look at page 7. You've kind of heard this theme, economic growth has been stronger than expected. And here you see how that has transferred into the equity markets. So because GDP has been strong, because the consumer's been strong, that's kind of flowed through to strong equity market performance. And so what we do here is we plot where each calendar falls in a 10% range of return for the equity markets going back hundreds of years. And then we highlight what's happened more recently. And interestingly, 2023 made it 8 out of the last 11 calendar years have had a double-digit return in the stock market. So that's obviously been a really strong, long, 10 plus years. You did have a little bit of a blip in 2018, and then of course 2022 was more of a struggle. But again, then we just in 2023 immediately returned to another strong return. And so this has been a really strong market because the economy has held up better than expected. And one of the reasons that we were comfortable raising our equity assumption, even though you've had this strength, is that the economy has held up better than we anticipated a couple years ago, when inflation was first, kind of coming or rising more dramatically. We thought that would cause a recession, but then we've seen the economy really kind of stay strong despite that. On page 8, the economy has done well, but it's interesting to look at what bond investors are sort of predicting by the way they invest their dollars. So this chart here shows the difference between the 10-year treasury and the 2-year treasury. And anytime the yield on shorter term bonds is higher than longer term bonds, that implies that investors are expecting a recession. And so you see that that's been true since the middle of 2022, where bond investors are expecting a recession. Of course, that doesn't cause anything, but it's just something that we look at to see, where do market participants think that the market is going based on how they're actually investing dollars. So this number has gotten a lot closer to flat. I think it's at negative 0.1 right now. Again, doesn't cause anything, but you see we've highlighted these other areas where either just before or just after a recession, that number went negative. This is the most wrong that it's been, or for the longest period. So again, doesn't cause anything, but just something to take note of in terms of how bond investors are thinking of things. On page 9, John looked at this for the June period. This is what was in place in December of 2023, which is around when we set these assumptions. So again, each of these dots represents a Fed member's expectation of what the Fed funds rate will be at the end of a given calendar year, or this sort of undefined longer term. And so just looking at the 2024, I wanted to point this out, how things have changed over time. You can see that, a lot of those dots were in the 4.5% to 5% range for 2024. So at the end of last year, it was expected that rates would come down faster than they have. If you go to the next slide, slide 10, look at that 2024, just a reminder of what we looked at. When John was speaking, you see that kind of has moved up. So a lot of this has to do with the economy holding up better than expected, and therefore, because jobs have been strong and the consumer has been strong, the inflation has been harder to get under control. But I would say, in the last couple months, maybe quarter, the Fed's dual mandate that John mentioned between keeping prices stable and keeping employment stable has kind of shifted a little to where the focus might be a little bit more on employment than it has been. It's been more focused on inflation. I think the shift is kind of more towards employment, which is why we expect rates to come down. And you see that the Fed, as you look at these dots across time, that the Fed has it sort of coming down in step till you get to this longer run in something to the 2.5% to 3% range that's effectively for the yield on cash. A couple more things on just the macro environment at page 11. So this is called 10-year break-even inflation. Again, this is just how are bond investors signaling with the way that they're allocating dollars, what they're willing to pay for bonds. How are they signaling their expectations for inflation? And really that's been in the 2 to 2.25 range. So even with all of this inflation we've had, bond investors have been signaling that they expect it to come down to something 2, 2.25. I think it's been right around there recently. And then there's another measure for that on page 12 that's just a different way of looking at how bond investors are projecting this forward. And again, that one is in the 2 to 2.25 range as well. So we're at 2.5, a little bit higher than that. But just kind of looking at, what are other market participants doing? Are they signaling something that's way different than what we're projecting? And we don't think that's the case. So both in terms of what the Fed's guidance is, what the market's kind of saying, and what other consultants, asset managers are predicting on inflation, we think that 2.5 number is pretty solid. any questions on the macro environment before we get to some of the individual forecasts? Okay, so page 14, just getting into bonds specifically. You know, I mentioned that we have a model for each of these asset classes in terms of how we come up with the expectations. So for bonds, you see the components here on this table. So it's income return, that's the yield or the coupon you earn from holding bonds. There's capital gains and losses. So as rates move, the appreciation or depreciation in the value of the bonds. And then a little bit of credit defaults, that's a smaller piece, and roll return, those are not as big of components. So it's really kind of income, and then are the prices going to change? And so the reason that our fixed income numbers are higher than they were last year is largely this income column. So because yields are higher, we expect you to earn a higher, of course, coupon or yield on the bonds that you're holding. And then the capital gain loss one is important too, because, you know, as rates have moved up, you've all seen, you've gotten negative returns on bonds. Well, now we're actually saying, at least in our view, yields or rates are kind of closer to where we think they should be from an equilibrium perspective. We know there's going to be volatility around that, but we think that they're closer to where they should be, or even, you know, for cash and on the short end of the curve, that should come down, which actually gives you a capital, you know, gains on your bonds. So that's also been an improvement, because in the past we thought rates were at extreme lows. Eventually they have to rise, which means you're going to lose money on bonds. Well, you kind of took all of that expected loss that we had slowly built in over a 10-year horizon. You kind of took all of that in a year or two, and then hopefully that means better returns going forward. On page 15, you can see kind of how we project the yield curve. And so really just the key thing I want to point out here is that the dark blue line towards the top, where it starts, you know, between 5.5 and 6, that's where the yield curve was when we started these projections. And then the other lines are where we think the curve will be at different points in our 10-year forecast horizon. Key component being we expect rates to fall on that short end, right? Because the Fed is signaling that they're going to cut rates, or at some point. We didn't know, of course, when that would happen, but we knew it would happen at some point and expected it to be in the first few years. And so that actually gives you an expected capital gain on some of those holdings for bonds, which is a nice change from the losses that we've been experiencing over the last couple of years. So the reason we come up with this expectation is just long-term history. The yield curve is usually upward sloping. You know, you wouldn't want to buy a 10-year treasury unless you could get something extra for it. Why take the risk of buying something that has a longer term if you can get 5% on cash? So eventually that has to come back into equilibrium, right? And then page 16, so we put this in here because, as I mentioned, fixed income has really been the area where we've seen the biggest changes in our capital market assumptions. I mentioned we try to keep them somewhat stable from year to year, but with fixed income, you know, it was really a historic, call it 3 to 5 standard deviation move in yields in just 1 year from 2021 to 2022. So that's just, you know, not something you expect to see from year to year. And so this just kind of shows you how the fixed income expectation, why the fixed income expectation has come up so much. So you see at the bottom of this page, page 16, the yield curve at the end of 2021, and then the dashed line through it is our expectation. So we had bonds expected to return 1.75 just a few years ago. And then you move up to the green line and you see what the yield curve was then. And that's why our expected return jumped all the way to 425 in just 1 year. And then keep going up the chart to the sort of darker teal or blue, and you see the yield curve there, and then our jump to 525 for bonds. So it's really just following the fact that yields are really the key component of the expected return on bonds going forward. So as yields have moved up, our expectations have moved up. One other thing I will point out, though, is that, you know, when we're modeling these projections from 1 year to the next, we're kind of putting the past in the rearview mirror. So, you know, we're saying, you know, when you went from 175 to 425, there was a big loss that year in the actual bond holdings. So we're saying that loss is already booked. Let's look at the next 10 years. So it's important to remember that each of these projections is kind of a fresh start where you've already put what's happened behind you. And so I just want to point out that if you were to account for the loss that you had to suffer to get to this higher yield, then you don't get quite as big of a bump in the expected return on bonds. For the equity forecasts, we'll get to page 18. Again, we have a model here that's specific to the equities. So we use dividends, buybacks, which a lot of companies are actually using their extra capital to buy back their stock. And that's kind of goes back to investors. We pass through inflation to stocks. I'll talk about that in a second. And then real earnings growth, which kind of follows, growth in the economy, GDP growth. So those are the components that lead up to our expected return. I think one of the key differences between this year and last year is the expectation that real earnings growth would be a little bit stronger because the economy had been stronger. And then on the inflation piece, I just wanted to, when inflation is a short-term shock, that tends to be bad for stocks. But as it moves to more of a long-term trend, those prices tend to get passed through to the consumer, which therefore passes it through to the investor. So that's why we put our returns in what we call nominal terms, which includes the inflation component, because inflation tends to, in the long run, flow through to investors. Page 19. I mentioned before that our fixed income numbers have been coming up much faster than our equity numbers. And so this is what we call the equity risk premium. So what are stocks expected to earn in excess of bonds? And I mentioned that for us, probably the relationship between asset classes is more important than the pinpoint estimate. We know our pinpoint estimates are not going to be perfect, right? It's more the relationships. So we are cognizant of the fact that this premium that you expect on equities over fixed income is lower than it has been, but we just think fixed income reacts quickly because yields move quickly and that passes straight through. It takes a little bit more time for the economy to work itself out for something like equities to actually adjust to the new rate environment. So that's why you see this premium coming down, at least temporarily. We'll get into private market forecasts. Here we show real estate on page 21. So this assumption went up from 2023 to 2024 by 25 basis points. So from 575 to 6. This was the only asset class that we did not increase last year. And this year we did increase it a little bit. I know we've talked a lot about this. One of the reasons is that core real estate, like the type that's held within your plan, tends to be higher quality than what you hear in most of the markets. So John talked about, the highest quality office buildings are still kind of in demand, at least relative to others. That tends to be mostly held by these types of investments. So just a reflection that, it's a little bit higher quality real estate. And then also, as prices have come down, we just think it's a little bit of better entry point to get more on real estate going forward. Again, we're sort of putting the past in the rear view and saying, what do we expect going forward? So that's why we felt comfortable bumping up that real estate number a little bit. For private equity, on page 22, I mentioned we kind of keep that similar to what we do in public equities. We want that risk premium or that illiquidity premium to be somewhat similar. So because our public equities went up by 25 basis points, private equity did the same. We do recognize that in the private markets, there's a lot of ways to implement. There's big differences between one manager and the next. So we're just trying to model sort of a down the fairway type of allocation to this. So that can differ depending on how you actually implement. Private credit on page 23, same idea. We know there's a lot of different ways to implement. And we know that tends to be variation from manager to manager. But we're trying to just model, sort of a broad allocation to this market. And so we bumped up from 7 to 7.4. Again, a lot of that is based on yields are higher. But if you think about that, 7.4 for private credit, we're actually pretty conservative on that number compared to a lot of our peers. So a lot of peers have a much higher number. But even for us, with a conservative number of 7.4 is getting pretty close to that equity expectation of 7.5 coming from private credit. Okay, so that's very quickly going through all of our new assumptions, what went into them, how we thought about it. We're going to get into how that impacts the expectation for your plan. Any questions on the individual assumptions or the macro environment before I get to that? Okay, so let's just go to page 27. Some of these other pieces are just details of what I've already talked through. So page 27, we've been showing this chart for a while now, and it's looking back at our capital market projections over history. What would a portfolio have to look like to get, in this case, a 7% return? And so you look back in 1994, you could have gotten a 7% return with 85% of your portfolio in fixed income because yields were so high at the time. And then you see as you move from left to right, the amount of fixed income is getting smaller and smaller because, both from the financial crisis and then again in the COVID crisis, rates were dropped by the Fed and in the markets to historic lows. And so you didn't have much of an expected return for that fixed income piece. So you see in 2022, that bottomed at, you could only have 4% in fixed income to get a 7% return. And then now, because we've seen such a big rise in our fixed income expectations, you see 2024, now you can get that 7% return with more than half in fixed income. Now, we always get this question. This is not reflecting portfolios we're recommending to clients. We never told clients to go down to 4% fixed income in 2022, and we're not saying you have to go all the way to 50% in 2024. This is just kind of an exercise of how the capital market expectations have flown through to a general trend towards fixed income allocations coming down over time. And then on page 28, when you put all of those capital market expectations together and run that through with your target allocation to each of these pieces, our projected return on your current target allocation is 7.7 with a standard deviation, or sort of think of that as like the uncertainty number around that 7.7 is 13.9. So that's up from 7.4 last year. And then on the right-hand side, we have all of these sort of pinpoint estimates throughout this deck, but we want to just remind you that there's a lot of uncertainty around these numbers. That's what that standard deviation captures, is the uncertainty amount. And so on the right-hand side, you see, in any single year, based on the projected volatility or uncertainty, you could have a range from, negative 14 to positive 34. With a median of 7.9. And then as you go to 10 years, those individual years of really big returns or really small returns or everything in between sort of narrow in towards that median expectation of 7.7. So you see that range starts to come down. But this is still an estimate of sort of a midpoint around which things might fluctuate. And so you see with the 7% target return, that we expect over 10 years, a 56% chance of meeting that target return, which is nice because we've been in a long period where, you were not expected to meet target returns. Not just you, but your peers as well. So that's really what I wanted to cover. Any questions or thoughts on our capital market projections?
Don't have a question about that, but I do want to address Mr. Higgins so that I won't forget this. Is that with the projection now that over the 10 years, it's 56% chance that we're going to be greater than the 7% that we're looking at now. The question is, how does that impact the liability with the funding request that we are making as a board? Let's don't answer that now, but I think with this projection, and what do we do with the excess over the 7%, and how does that impact, and how does that impact what our requests are for funding through either requests for increase in contribution rates or direct contributions. So I think we need to address that. And it may be more appropriate in the legislative committee tomorrow when we're talking about legislation,
Sure.
things that we're maybe requesting and how we're working toward that. I'm sorry to interrupt, but I didn't want to lose my train of thought to where I wanted to get to with that. Okay,
Happy to do that at the proper time.
okay, thank you. All right, board members, yes.
Thank you, Mr. Chairman. So you've got the 2024 assumptions, 2023 assumptions there. When do you start getting nervous on projected standard deviation? When does that start worrying you that it's getting a little bit too far? Because that seems a little bit high to me right now as far as risk. So, but of course, this is a 10-year capital market, not the actuaries, but that seems a little high to me. And if you
The standard
lower,
deviation piece?
yeah, and if you lower that 7.7 to 7, does that standard deviation naturally go down also? I know it depends on the
Likely,
mix,
because the way you would do that is to add more fixed income, which is a less volatile asset class with highly diversifying to your equities. I don't think there's a standard deviation number that makes me nervous. I think it's, what are your needed returns to meet your obligations? And then on this bar chart on the right, the standard deviation just tells you kind of what's the downside that you're taking to get to that median number. So I think that's where it starts to be more real to people is, okay, now I can see an actual number of, okay, in a given year, that means negative 14%. Can I handle that in a single year to get to this 7.7? If you drop that standard deviation, let's say you're going for a 7% return, maybe that's a negative 12. So it's not so much that there's a standard deviation number that scares me. It's more for you all to collectively think about what the trade-off is between that target return and the risk you have to take to get that return. Does that make sense or help?
yeah, and by that risk, the higher that number, the more you're swinging for the fences. Is that not?
A little bit, yeah. I think I would say that, we could look at this, but, for being in the 18, you have 18% fixed income and 1% cash. I would say 20% fixed income is pretty common for public plans, peers like yours. So I don't think that you would be out of line relative to peers, certainly, if that's helpful. And then it just becomes a question of what do you collectively feel comfortable with?
Thank you.
Freeland, I would say back in 2022, the standard deviation was 14.2 as well. So, when you lowered it, it just appears that standard deviation, but it's been very consistent. But I think I want to point out to bring this up, that this page is important and critical to us in decisions going forward, because this page says with our asset allocation, this is what the projection is, not what the general market does per se. This is our asset allocation at this point.
That's right. Everything I went through is kind of building up to what does that mean to you?
Yes. So if there's a page to save, board, I would say that this would be the page for decisions that we have to make. Any other questions? Mr. Nelson, where are we now on the agenda?
On the agenda, next item is the investment policy statement. Basically, the revisions there are just fixing formatting issues that I did not catch the last time we did this, and then adding the updates to the policy benchmark target, including the Cambridge Global Private Equity, and then the change in name for the private credit benchmark. Morningstar bought the benchmark rights from Standard & Poor's, so the name changed. Those are the only major changes there, and I am asking for approval of these revisions.
Make a motion to accept the staff recommendation.
We have a motion for the investment policy review changes. Do we have a second?
Second.
We have a motion and a second. Any further discussion on that? All those in favor say aye.
Aye.
And those opposed by the like sign, there being none, those, the changes in the policy have been approved for us.
Thank you, sir.
Now, but I didn't mean to cut Callan short. Now, if you had anything just burdening your heart that you wanted to share with us, go ahead and do that right now.
No,
On any of your presentation. I thought it was a good presentation. John, yours was too. I'll even extend it to Alex. Good job. Okay. Anything else? All right, Charles. Next is our manager presentations. Is
Next
that what
is
that is?
manager presentations. I
I'm-
believe lunch is
Yeah,
ready.
lunch, yeah.
We are actually running about 20 minutes behind, so.
Actually, what I'm gonna suggest is we go ahead and break for lunch, if this is okay, and come back and aim for 1 o'clock to start back at 1 o'clock. Does that sound reasonable?
Sounds fine to me.
Yep.
Okay, then we will recess the investment committee until 1 o'clock.
Thank you.
Charles. Yes, we do. Hold on just a minute. Let me make sure.
See those,
I think it's 1 o'clock now, so we need to call, it's
Everything
shortly
go?
after, we need to call, reassume and restart the investment committee, and we have the domestic small cap managers, 3 of them. Who's going to give us an overview of that before we start? Okay. You can sit here. He said he's not here.
There's 2 chairs, I think, here. So somebody else wants to sit there.
Mr. Chairman, Ryan Holloway's
Ryan?
here to give you an overview of who's going to be presenting to us today.
Very good, Ryan. Go ahead.
Good afternoon. Today we have our small cap managers presenting, and that's Dimensional Fund Advisors is our small cap value, Riverbridge Partners, small cap growth, and then Wellington is our small cap core portfolio. For DFA and Wellington, the performance has been great. Riverbridge, unfortunately, they're a growth manager, and that's just been a tough space to be in recently. So short-term performance has not been great, but still long-term, they're doing well for us. I'm happy to answer any questions y'all have on them if you'd like me to go deeper into any of it. And if not, I can go get DFA and let them start the presentations.
Let's go ahead. Any questions? Let's start with the presentation.
Great, thank you.
Sure got quiet in here.
What does it look like? Is that this one?
Bring it with you?
Welcome. Want to welcome you all to the investment committee. And I believe you are the dimensional. Is that correct?
Yes, sir.
There we are.
Well, wonderful. Then I got the right slides up here. So we're ready to go. Let's just turn it over to you.
Right. Well, thank you. Thank you for having us. Pleasure to be here. I am Rob Cleary, and I've been on this relationship about 5.5 years, but it might be my first time in this room. I'm a little bit of that on COVID, and last year I just sent someone on my behalf. So it's nice to see everybody. It really is. We always want to be accessible, and we want to be a face behind the name, so you always know who you're working with.
Could you move that microphone over just a
I'm
little
sorry.
ways? Thank
Yeah.
you.
Normally get an opportunity.
Some of us old folks can't hear.
Thank you, sir.
Thank you. I'm joined today by Luke Smart. Luke Smart is an senior investment director at Dimensional. He's been with the firm for a little over 14 years. He was the head of our large cap desk. He recently spent 3 years at BlackRock, and we got him back. So we can talk about that a little bit, but only if you want to. But he was head of the iShares factor business at BlackRock. So really a pleasure to have him back. He's a CFA, and he also went through University of Chicago for his MBA, which is definitely a high trafficked area from Dimensional. That seems to be a pretty strong feeder into Dimensional. It's where our founder, David Booth, has invested a lot of time and money and commitment to that school. So really enjoy that relationship. Just to kind of revisit on me again, I've been covering the Southeast for institutional business for the better part of 20, I don't even want to say it, going on 30 years. It just sneaks up on me. We have a good report for you today. We have a really, really nice report for you today. Small cap value has maybe had some, some fits and starts, but we still have a very, very good report. 3 and 5 years, we're at 500 basis points over for 3 and 5 years. And even 10, it's a very healthy number. So just a really good quality report for you. I'm just going to take another few minutes before we turn things over to Luke. I think it's always important to just expand the way you think about dimensional. And on page 8 of your deck or your slides, some of this may surprise you. You know us as a small cap value manager. You know that our premium, size, value, and profitability are beholden to us. Yet we have a very full footprint across the U.S. market, across developed, across emerging, and we even have a fixed income business. So it's nice to create that awareness. We are really becoming a solution provider underneath the big three. The big three being BlackRock and Vanguard and Fidelity Northern Trust. We are really finding a sweet spot beneath those mega three. We're at $740 billion in assets under management, which is a nimble number compared to those multi-trillion-dollar managers. It really does allow us to be creative with clients. And with a number of state plans, just a few, just to mention, these are all public now. It's Alaska, Texas, Arizona, New York, and Oklahoma. We've recently opened up very nice relationships with these groups, and it's more in line with market-aware approach, or think of better indexing. When you think about indexing, we think you leave a lot on the table. So what we'd like to do is, first off, become very aligned philosophically with our client, have a very thoughtful approach, and the expectation is to outperform. So we've really seen quite an uptick and an engagement really across our market-aware approach. And what we do for you is small cap value. So we can be anywhere from we call it a component, a targeted strategy, to a market-aware approach. It's a different expression of our core principles. That's straightforward, okay? With a lot of implementation, that is really our secret sauce. And I think that might be a good drop-in point. Luke, is there something that I promised I'd get to first?
No, I think that's perfect, Robert.
Okay.
Pleasure.
Yeah, great.
And thank you again for having us here. It is a pleasure to see you all. I see a number of familiar faces. I've been here in the past. It's an honor and a pleasure to be here. So thank you again for having us and for being such wonderful partners with Dimensional. Just really high level to refamiliarize you with Dimensional. Dimensional is a firm founded on a singular philosophy. That idea is that markets work. From that philosophy, as Rob has identified, we can expand into all different parts of the market. And we can do so in a way that maintains our buy-sell discipline, as well as maintains our value proposition for our investors. We are more than just a factor provider. We believe that we can add value through an active framework. That allows us to add information that you see on page 11 of the materials. Of course, we position our strategies around the long-term drivers of higher expected returns. That's on the left-hand side of your page. Those dimensions are size, style, and profitability. To make it more accessible, what we're looking for is companies with good earnings, and we want them at good prices. We measure good prices two ways, both through relative price as well as company size. But of course, we can add value beyond that, and we do so through active implementation. And there, it's really about the incorporation of short-term information. We can add value or preserve value through incorporating information on reinvestment. We can look at the momentum and reversal, recent performance of securities. We can even gather information from the securities lending market, which is also another way that we can add direct value to a client's portfolio. And of course, we are very well known for how we execute in the market, turning what is normally considered as a disadvantage in the space being a large asset manager working in less liquid markets, into an advantage by providing effectively liquidity to the marketplace. That is all at play in your strategies. Now, it has been approximately a year since Dimensional was in front of you last. So I will cover 1-year performance, and at the board's discretion, if you would like me to go into more recent performance, I'm more than happy to do so. I will pause once we get through the quarter. Just to orient you with performance for the year, I'm looking at page 14, that's 1-4. What we saw for the 1-year period ending June 30th is that small cap stocks underperformed their large cap peers. However, as you know, this strategy is positioned in the value portion of the market. Within small cap stocks, we saw value stocks outperform their growth counterparts at 11.3 versus 9.3%. You see that in the bottom middle of the page. Of course, what we're looking for is companies with good profits at good prices, which moves us into the profitability portion of the small cap market. We saw a significant outperformance of higher profitability small cap stocks within that space. Both the value premia as well as the profitability premia will help you understand the outperformance of your portfolio relative to its benchmark, the Russell 2000 value. In the interest of time, I'm going to move forward quite a few pages to page 19, just to give you a brief reminder on the construction of your portfolio. We will focus on the picture on the left-hand side of the page, and I'll give you a moment to flip pages. I know I asked you for quite a jump there. The rustling of pages has stopped. I'll continue. We'll focus on the picture on the left. That picture is an idealized representation of the U.S. market. We have large cap stocks on the top, small cap stocks on the bottom, value stocks, which we call low relative price, which is another way of saying price to book, on the left-hand side, and we have growth stocks on the right-hand side. Our first step in creating this portfolio is identifying small cap stocks. We identify small cap stocks as the bottom 10% of total market capitalization. That is an important methodology that gives us a very consistent definition of what is small cap, something that we don't see in number of names approach that is applied to common indices. Within what we've identified as small cap stocks, we next need to identify value stocks. We do that by looking at the lowest 35% of price to book within the small cap space. Now, I'm going to move you from the picture on the left to the picture in the middle of the page. This is an expansion of the portion of the market that we've pre-identified as small cap value. We recognize that liquidity is meaningful and can be a detractor from performance if we push on the market too hard. So instead of a tilted approach, which would induce turnover in the strategy, we prefer a strategy that carves certain portions out of the market. That accomplishes two things. First, it enhances the overall profitability of the small cap value space, but it also makes this approach multi-metric, or multi-factor, I should say. By making it a multi-factor approach, enhance the robustness of your expected outperformance, meaning that we can maintain a similar level of expected outperformance, but the variation relative to the index is reduced. Again, in English, what that means is that because we can rely on multiple factors within this space, we don't have to take as significant a departure from the market in any one of them. The way we do that is between the 30th and 35th percentile elimination of roughly the bottom 50-ish% of profitability, with the removal of the bottom 10% of profitability throughout the remainder of the space. We have characteristics for you at the bottom of the page, should you prefer to go through them. Most people are satisfied with the picture, so we'll call it there for the day. I will move you forward to page 21. Page 21 will give you an idea of the sector allocation of this strategy. We have in blue, the weight of the portfolio, Mississippi PERS small cap value portfolio, and in gray, the weight per sector of the Russell 2000 value index. There will be some measure of sector rotation in this strategy. We do protect this strategy through capping the maximum sector exposure in the broad market, meaning the broad small cap market, plus 10%. Where that has come into play in the past is in financials, That usually comes into play, and energy. That usually comes into play in the large cap space. That has not been a challenge in the small cap space. You can see that our deviations relative to the Russell 2000 value are fairly tight. Two more things that are material for this understanding of the strategy. We do exclude real estate investment trusts from investment. We also exclude highly regulated utilities, which in the United States is a large majority of utilities, from our component-based strategies, our value growth strategies. I'll move you to performance. I'm very pleased to report very strong performance over the 1-year period, ending June 30th. We returned just under 15%, in comparison to just under 11% for the Russell 2000 Value Index. That is an outperformance of approximately 4% over the 1-year period. In second quarter, we performed roughly in line with the index, down 3.5% against down 3.6-ish% to the Russell 2000 value. That, as Robert identified earlier, we're very happy with that 1-year performance. We are equally happy with the 3- and 5-year outperformance. We've been serving you for a very long time, and we are very, very happy that your patience has been rewarded. So thank you for that. I'll pause here for questions, and if you would, to see if there's any other time periods that you'd like me to cover.
I think it's well known that you guys are excellent in small cap value. I mean, it's evidenced in just your last 3-year performance ending July of, outperforming by 750 basis points. I think more than that, actually. Now, tell me how you guys can implement your strategy in a core all cap. I understand the value premia. Talk to me about what would it look like for a core all cap strategy, regardless of whether it's global, domestic, etc.
Charles, thank you very much for the question. To repeat it for everybody, what would our implementation look like in a core all cap strategy? I'm very pleased to report that we've been implementing core all cap strategies since the early 2000s, both across all regions, the United States, developed markets outside of the United States, emerging markets, as well as a global exposure. The way that we implement that does follow the same value proposition. We add value first and foremost through exposure to the factors, but moving beyond that, we continue to add value through the incorporation of short-term and intraday information into the portfolio. We further enhance the portfolio using some of the liquidity available in the market through a tilted approach. These approaches also tend to be multi-factor, meaning that we use size, style, and profitability, and we do so in a way that's appropriate for our clients' total portfolio. We have both commingled strategies as well as separate strategies where we have discretion we partner with our clients and the separate strategies to dial it in for what's right for them. In addition to that, I think I'll stop there. I don't need to embellish.
So recently, indexes, regardless of what people think, they're very concentrated.
Yes, sir.
Indexes are. You guys have large holdings, in your process. How do you keep yourself from falling into high concentration positions just because of, the size and breadth of the portfolio?
Thank you. And again, the question is one of concentration, which has been a significant issue that the market has been dealing with lately, particularly with the Magnificent Seven in the United States. We manage our concentration several ways. The first and foremost is that we pursue broad diversification. We are not excluding securities that are not necessary for the objective, unless they are not necessary for the objective of the overall strategies. You will notice that your strategy has quite a few number of names in it. If you expand outside, if you expand to a core mandate that in the United States, that'll have approximately 2,800 securities. If If you look at a global mandate, we're talking 14,000 to 15,000 securities in the overall strategy. So broad diversification is our first stop. The second is a recognition that our value proposition comes through the addition of long-term expected returns through the factors, in addition to incorporating short-term and intraday information, which means that we want to protect the portfolio from unrewarded risk. And in our view, unrewarded risk comes with individual stock concentration. We do that by incorporating an issuer cap within the portfolio. That issuer cap is 5% globally, where we will not target increasing the weight of a security once it has hit that 5% mark. From a regulatory standpoint, our strategies do tend to be diversified. So per the SEC diversification rule, our top 5 positions will need to be less than 25%. There is some float around that I won't bore this board with the details there. Additionally, I will remind the board that this is a actively managed strategy, which means that we have the ability to interact with the portfolio every day. We are not waiting for a rebalance period in order to make an adjustment to the strategy or to change the weight of a particular position. So we can be on top of it continuously and in a way that, which in turn allows us to manage the portfolio throughout the year and do so in a way that preserves our ability to trade efficiently on your behalf.
Thank you.
You're welcome. Thank you for the questions. I appreciate that. May I help anyone else? Yes, sir.
You spend a moment just talking about your exclusion of real estate from the portfolio.
Yes, of course. When we look at real estate investment trust, well, we're going to come at this from multiple ways. One which is not particularly relevant for you. First and foremost, real estate investment trusts tend to issue non-qualified dividends. That can typically be a detractor for taxable investors. So one of the ways that we can enhance the tax efficiency of our overall portfolio is through exclusion of that particular part of the market. When we look at REITs broadly, this is the second more relevant portion of the explanation for you. We do not see that emphasizing value, size, or profitability within that sector adds additional value. We do not have sufficient evidence to say that the factors work in that space. So it is not a way that we can, when we look at that performance, it's going to be more broad. Your strategy in particular, since we are in the small value portion of the market, it makes little sense to incorporate something that's going to act more like the broad small cap market. That can be a source of tracking error relative to the benchmark, recognizing that the Russell 2000 value, the overall allocation for REITs in the US market is typically around 3%. But if you look at the distribution of real estate investment trusts, they tend to sit in the small value portion of the market, which means that we see an increase in the relative weight in that space. But long term, it is something that has both worked for and against us, most recently for us in a higher interest rate environment. You're welcome. Thank you for the question. I'm probably going to be your most boring meeting today, and that is a feature. How else can we serve you?
I've got one question. So as you've indicated, your short-term and long-term performance is very strong, perhaps compared to others. If you had to put it in one sentence or one paragraph, what's the secret sauce?
One sentence or one paragraph. I get a paragraph?
That's right. So you can have some flexibility there.
The factors are the star, but you need to go beyond the factors. Let me think about this. I want to give you something good for the record. The factors are the star, full stop. You need to go beyond the factors and execute with good implementation. You can give it all up if you're not careful and smart. And we have over 40 years of experience in doing that well.
Thank you.
Welcome. Thank you for the question.
Sounds like the execution, if you put it in one word, maybe.
Oh, you're better than I am.
Yeah.
Do you want to swap seats? You got a better tie too.
Yeah.
Other questions from the board? Anyone else at the table? Do you have any further presentation for us? If you do not, we want to say thank you for coming, and if you do, please share it with us.
I'm done. Would you care to say anything?
We feel that was a great exchange, and we thank you very much for your time. We were told that we keep it inside of 30. That's the way to go. But no, thank you very much for your time, and we're always available. Don't ever hesitate to even think about reaching out. I'm always there to help you any way we possibly can, to grow your awareness and backfill any areas of interest within Western's profile. I'm very happy to engage in any of that. So thank you very much for your time today.
We only ask that you continue the good returns in all market situations.
We will do our level best.
Thank you for coming
Thank you.
today.
Thank you.
That Friday night. It's all coming in 3 years. Yeah.
Will you drive right there?
I hadn't decided where I'm going or not. If it was at home, I would go for sure. Now, that was DEA, wasn't it?
I got an idea. I'm on the right track.
There's River Bridge. What does that look like? Right, what does River Bridge look like? Yeah. That black one. Now, these people are the people who start money. Tupelo got Friday night.
We thank you all for coming down and being with us today. Hope that your trip down from Minneapolis was nice, and we tried to raise the humidity a little bit just for you. So we're gonna turn it over to you all to make your presentation to us.
Wonderful. Well, just before we begin, I want to thank you all and the investment committee for the opportunity to present. We thank you for the 10-plus year relationship that we've had now. We appreciate the trust and confidence that you've placed with us, and take very seriously the responsibility and the opportunity that we have to steward the assets on behalf of your participants. So thank you. Real quick, I'm Andrew King. I'm a relationship manager at Riverbridge. I've been with the firm for over 12 years. And with me is Adam McGrain, one of our portfolio managers, who's been with the firm for over 16 years. Real quick, from an agenda standpoint, we won't go through all the slides in the deck. I'll point you to the ones that we plan to reference. But given that it's been a little bit of time, I'll briefly review the investment philosophy and process, and then turn it over to Adam to review recent performance. So with that, I will have you turn to page 5 or slide 5 in the deck. Riverbridge, we have deployed the same investment philosophy and process since our founding in 1987. Shortly after our founding, we started our small cap strategy, which the inception date is June 30th of 1988. We are long-term, bottom-up fundamental investors investing in companies that we believe can achieve high returns on invested capital over a full market cycle. Our overarching investment philosophy is that we believe earnings power ultimately determines the value of a franchise. So what that means is we are looking to invest in companies and alongside management teams that are making the proper decisions, not necessarily for the next quarter or for the next year, but really for the next three years, 5 years, and beyond that. So our philosophy and our process starts around really assessing the quality of the management team and the company in which they are managing. And so we still do a lot of hands-on, in-person research. Our team spends a lot of time in planes and in hotel rooms, meeting face-to-face with the companies in which we are invested. On the right side of the page, you'll see what we define as our building blocks. In addition to investing in well-managed businesses, we define growth as unit growth. We are looking for those companies that are selling more of what they make or do each and every year. In addition to that, we want all of our companies to operate in a strategic market position. So what this means is we want them to be the leader in their space. We don't want them to be competing in commodity-based businesses on price, but really offering mission-critical products or services whereby they inure themselves a deep customer relationship with their customers, bring them the next problems or challenge that they're trying to solve. Our third building block is conservative accounting. We want our management teams to deploy conservative accounting policies, specifically with respect to revenue recognition, as well as monitoring for changes in accounting policies. We believe that this is a very good cross-check on the quality of the management team in which we're dealing with, as well as just a good indication of whether they're managing the business truly for the long term. And then finally, and most importantly, we want all of our companies to be able to internally finance their own growth. So even in our small cap portfolio, there's very few companies with debt on their balance sheet, and they can all internally finance their own growth. So this gives the management teams, to the greatest extent possible, the ability to control their own destiny. When we get in times of stress in the market where it becomes challenging to access capital either via the debt markets or through the equity markets, our companies can continue to internally finance that growth. So what that has resulted in, if I'll have you turn to slide 8, is a very strong record of long-term performance. Our performance objective is to outperform the benchmark over a full market cycle, which has been lengthening in recent times. What you'll see here is a rolling batting average chart, whereby on the y-axis is the batting average, which is the percentage of time that our small cap growth strategy is outperforming the benchmark. On the left side, over a rolling 1-year period, moving to your right to a 10-year period. So what you'll see, about 60% of the time, we outperform on a 1-year period, or another way to say that is about 40% of the time we'll underperform. About 30% of the time we'll underperform on a 3-year basis, and about 20% of the time on a 5-year basis. But what our philosophy and process results in is, and what we believe is that fundamentals matter over the long term. And what you see is that really over every 10-year rolling time period since the inception of our small cap growth strategy, we have outperformed the benchmark on a net of fee basis. So, if you flip back to slide 7, this is a little bit going to just the unpredictability of the market over the short period of time, and you see a wide degree of returns over a 1-year period of time. But as you see those bands narrow, the orange graph being Riverbridge, the gray being the Russell 2000 growth, consistently we are outperforming the benchmark, and in fact have never had a 10-year time period in which we have had a negative rate of return during that time period. So again, just to kind of summarize, long-term oriented manager that we believe are fundamentally, we are concerned about the fundamental progress of our companies, and over a long period of time, it's been very true that we've been able to outperform the benchmark with that. With that, I'll turn it over to Adam, who will take you through to page 10 in the deck.
Page 10 has most of the rest of our portfolio statistics, kind of some of the holdings, recent performance, and some other numbers if you'd like to get into. But overall, as we sit here today and assess the markets and our performance, we view the markets right now as quite speculative. Whether it's speculation about what interest rates are going to do in September, December, what Bitcoin may do, whether we have a hard or soft landing. You have AI, you have world conflicts, and of course, this small election that's coming up. There's a lot of uncertainty, a lot of speculation that you're seeing drive the markets up and down kind of in the near term. For us, from a relative standpoint, it's been a difficult year for our relative performance. There's a number of things driving the market that we don't have a lot of participation in, AI being probably chief amongst them. You know, there's a lot of speculation around AI, the infrastructure that's being built around that right now. You're seeing semiconductors companies do really well, a lot of hardware equipment, and those are areas that we typically don't have a lot of exposure to. You know, they go through periods where their demand is very strong, followed by periods of time when that demand falls off quite substantially. Ultimately, there's a significant part of that part of the market that isn't differentiated, and they kind of get real competitive, and over time that margin lift that you're seeing, that demand that you're seeing right now gets competed away. You know, so we've missed that to an extent, but it's an area of the market that we're content missing because we don't think that long-term it's sustainably differentiated. When it comes to AI, where we have most of our investments is more in data companies, software companies, and services companies. How do you actually take a brand new technology and make it applicable to the world, right? Like, I'm sure many have perhaps used ChatGPT or other AI, and it's great at rephrasing words or helping you write something out. But, you know, in the future, when it's making businesses more efficient, when it's making insurance companies better at understanding the risk that they're taking because they're able to feed it data models, that's where we want to remain focused. And those are the investments that we have. So, you know, we have a company in our portfolio, Globant, which I believe is a top 10 position. Yeah, it's number 6 there. They're an IT services company. They're going to help actual end customers understand and deploy that AI technology into their workflow. You know, another company that we own is Kinsale Insurance. It's going to help them underwrite better, give better pricing to their customers, more effective pricing where it makes sense. It'll also help them figure out fraud. You know, are there areas of claims that are perhaps more fraudulent that they should be looking into more carefully? So those types of applications are what we think is kind of the long-lasting impact of AI, and that's where we want to remain focused from an investment standpoint. Then just quickly, you know, a couple other areas of the market that have done well so far kind of this year, biotech, more asset-intensive areas of the world. Those have done well kind of in the speculative-driven market, kind of stimulus-induced to some extent, as people find more funding, and we think that we're going to get more of a soft landing. So those are areas that we typically have lower exposure to. We want to have companies that can grow regardless of the economic condition, and that's what we're really focused on. So it's retailers that are building more stores, finding more traffic. It's software companies that are developing new modules, finding new customers, and it's industrial companies that are going to do well whether the economy's in a great shape or not so great shape. So we have a lot of services companies as opposed to like asset-intensive types of businesses. You know, and then finally, there's a piece from a stock selection standpoint that sometimes you miss, and we certainly have that when we're performing well as when we're not performing well. You know, and it's our job as an investment team to kind of go through those companies and make decisions as to which of those companies are struggling for short-term reasons. You know, like a Five Below has been a retail concept that we've owned for a number of years, I think over 10. And, you know, they've done really well over those 10 years, but right now their core lower income consumer is struggling a little bit with the inflation impact that they've had to deal with the last number of years. So they've seen softening sales. But what we like about them is they continue to open new units, new stores. And that ultimately, as things normalize from a consumer standpoint, they again will have kind of robust margins and growth that we expect of them. You know, on the other hand, there are companies being small cap that no longer work for us. We kind of have our expectations for them, and when they don't meet those expectations, we need to move on from them. So, you know, a couple companies like an AMN Healthcare, a Definitive Healthcare that we've sold throughout the year are examples of those companies that we expected to come out of kind of the COVID era with a little bit more strength, a little bit more appeal to their customers, and they didn't quite meet our expectations. As we look out to kind of the remainder of 24, we certainly think it remains a volatile environment. Generally, that favors our type of style when investors are becoming more discerning and careful as to what they invest in. When they care about companies that are providing mission critical, essential products and services to their customers, that's what our portfolio and your portfolio is invested in. We're not trying to time certain elements of the markets. We want to have companies that are always going to be standing with their clients, helping them operate more efficiently, grow their revenues, and maintain their market share. So the best example of that is really the dark days of COVID. That was when our portfolio really stood out. Our companies generally provide something that their customers can't do without. That's what we're trying to find. So our focus continues to be just on building that portfolio of high quality, finding those market leaders with aligned management teams and strong balance sheets. That's ultimately what we're trying to decipher, is find those management teams that are thinking in those outer years, not just about the next quarter, but how do we build a successful business over 10. And then the things that we look to just in support of small cap, certainly rate cuts are going to support small cap overall. It's been a pretty narrow market, even amongst some small cap elements in the market. And as rate cuts happen, that will likely broaden out the participation overall in just small cap performance. As part of that, why rate cuts are happening is certainly important, right? Inflation seems to be ticking down. Rate cuts generally show that the economy is softening. And that's where we do think that our portfolio is particularly positioned well. Because again, these aren't companies that are reliant on that overall GDP growth or economic expansion. They're going to do well even in slowing economic times. So, we know we're underperforming on a year to date and kind of in the more recent term numbers. That's partly a result of we don't manage to the benchmark, right? So we do know we're different than the benchmark. There are periods of time when we look much smarter than we probably are, and then there are parts of period of time of the cycle when we look less smart, is probably a nice way to say it. But for us, it's kind of go back to that same process, that same philosophy that served us since 1987 and find those great companies that are going to build their earnings power consistently over long periods of time. That's ultimately what we do and what we will continue to do for you. So, as Angie mentioned, thank you for having us and the partnership and the trust for the last 10 plus years is probably the official time measurement. So,
do we have any questions from board members or the director or others at the table?
I know that every great ball player goes through batting slumps, and I understand. As far as narrow markets go, and like you said, we've seen narrow markets regardless if they're large cap, small cap. If the markets continue to be narrow over time, do you guys have a way to adjust, what you're doing to compensate, or what are you doing there?
We typically don't react to the type of benchmark thing. We aren't going to buy. There was a particular company, Supermicro, that has infected a lot of the small cap benchmarks and led to a lot of that narrowness of performance. For us, it's less about mimicking the benchmark and making sure that we own the 45 to 55 best companies. So there wouldn't be any significant change in our style, our approach to how we would build the portfolio, even with that theoretical continued narrowness of the market. It's not something that we think is sustainable long term. You're starting to see that broaden out even in the larger cap indices. That's certainly an element just from a fundamental standpoint that we need to make sure that we're on top of. Even though a stock may not be performing, you can see really strong fundamental performance, but for whatever reason, the market is favoring some other style of asset. That's where we have to just continue to ground ourselves and center ourselves as to, which are the companies making fundamental progress. And not kid ourselves either, that there are some companies that don't meet those expectations, and we need to move on from those types of companies.
So I'm going to piggyback a little bit on Charles' comments about recent performance, right? So as we look at the past track record, outperforming 6 out of 9 calendar years, coming into the recent performance. The names that you've excised from the portfolio, can you just touch on that? Some of the dispositions that have taken place, whether it's due to valuation, acquisition, themes that haven't borne out.
Yeah, I'd say the vast majority of them are us choosing to exit companies that haven't worked out, or that we've simply found better opportunities to invest in. Right, there's always kind of a hierarchy of companies in terms of the most conviction, medium conviction, and lower conviction. And when we find a new company to invest in, because we're fully invested at all times, we need to sell something to make room for it, to find the available funds. So that generates a significant number of those transactions. That said, 3 of the 9 on the portfolio are from acquisitions. So when I look at Model N, Squarespace, and Amedisys, those are companies that were deemed to be either a strategic fit for a larger buyer, or perhaps from PE, seeing a disconnect in valuation and choosing to purchase those companies. And then there are some that, like an Ollie's Bargain Outlet that, we sold choosing another company. Not that Ollie's was a broken company by any means. It's done rather well, actually, since we sold it. But us making a decision that from a long-term standpoint, we'd rather be invested in another area than that particular company.
Yeah, and I would just add, John, 3 of the companies have been acquisitions. We went through a period like this back in kind of 15, 16, where you started to see the disconnect in the fundamentals from our company started to look pretty attractive to strategic buyers and even PE buyers back then that were coming in and buying growth companies. We're starting to see that again, where there's more M&A activity on the companies that we own, just given that they've done well, but maybe are operating in less favorable areas of the market, and they're seeing a reduction in the valuations.
Thank you.
Yes, sir.
So I think I heard you say you had low leverage companies is what you prefer. Is that an advantage that you see to some extent? Because you don't have leverage, so in some of the ratios, of course, that would come out to be not as good on paper as it would be otherwise, since they don't have the debt. Does that factor in as a positive all the time, you think, or negative, or just varies depending on the market?
We think it's a long-term advantage for a company to have a strong balance sheet, right? It doesn't always matter, but there are periods of time, go back to COVID being the most recent example, and further back kind of 2008, 2009, when having a strong balance sheet is a significant differentiator for our companies. They don't have to be able to grow. They don't have to come out to the equity markets or the debt markets and ask for capital. They've got the internal balance sheet, the internal cash flow to invest appropriately. There's no better time for a company to gain market share, to extend their product leadership when others can't. And that's what we want our companies to be able to do in all times. Invest in the appropriate growth investments that you need to have. And that's why it's such a strong part of what we believe in. It's why it's a building block. It's an absolute requirement for our companies to be able to internally finance their growth. There are certainly times when it makes sense for a company to have some amount of leverage on their balance sheet. Usually that's as they mature, right? You're no longer trying to find growth and fund that. You're less risky, so you can get your cost of capital down, that's when it makes all the sense in the world. But being in that position where you have a strong balance sheet, where you've got supporting cash flows to fund your growth, is certainly an advantage that we believe strongly in for the small cap, and especially the small cap growth element of the market.
That limits obviously that limits the number of people or stocks that you could.
It does.
Limiting is that?
Yeah, it could. We don't find that to be a limiting factor in kind of selecting the universe, but it certainly removes elements of the market, particularly around financials, energy, some materials companies, utilities, that you would expect to find more leverage. We tend not to invest in those companies anyway because they are typically tied to kind of commodity cycles or interest rates. They've got a lot of macro risk and exposure to them that we typically don't like to take. And there are certainly times when those types of securities are in favor, but more often than not, we'd prefer to have something with a management team that can control its own destiny.
Thank you.
Other members of the committee? If not, we thank you, gentlemen. Andrew, Adam, thank you all for coming down and sharing with us about your company and your performance over the last little while, and we're looking forward to great times in the future. Thank you all so much.
Thank you very much. Appreciate it.
Is that when a brownie becomes a cake?
That came today. I'm thinking that they cooked the pan this morning early, and they think, we cooked too much. We gotta get rid of that. That's a cake right there now.
That's a brick.
I'm carrying my granddaughter out for supper tonight, and instead of dessert, I think we're gonna half this. That's what I'm gonna do. Yeah, that right there. Hey, and that'll stick to your bones too. That right there. It'll fatten you up. If you had some of that for your cows or hogs now, it wouldn't take long. Wellington. Good afternoon.
Hello, everyone. How are you?
I'm great. How are y'all today?
Doing well, doing well. Thanks for having us.
I'm Randy McCoy, Chairman of the Investment Committee. We're happy to have the Wellington Group, our management group here this afternoon. So we got, I think enough people are here. So we're going to go ahead and turn it over to you all to give us your presentation.
Good. Great. Well, it's great to see everybody. Thanks for having us. So for me, this is a bit of a return visit. My name's Greg Williams, Business Development Manager based out of Wellington, Chicago office. I worked on this relationship years ago, and then obviously I think many of you know Zonder Grant, who became part of the relationship, and then Juliana Lucas, who then took over after Zonder retired. Juliana's moved on to a new role, and so I'm back, for better or worse for you. So we'll see. Hopefully it's for better. But we appreciate your time today, and it's great to see everybody again. We also want to lead off by just saying thanks for your partnership over many years. It's been great working with you. And I'm joined by DJ Fitzpatrick, who's the lead portfolio manager for what we're doing in small cap opportunities. I'll be super brief at the firm level. Nothing has changed at Wellington, but I would impress upon you a couple of things. If we just turn to slide number 4 in your presentation, and this is just a visual depiction of our firm. So as you'll see here, we manage a little over $1.2 trillion in assets right now. I'd say, the 4 boxes in the middle really just depict the key underpinnings of what we think makes Wellington different. As you've gotten to know over the years, number one would be our partnership structure. We're a private partnership, and we will continue to be a private partnership over time. We think that's important for a number of reasons, but first and foremost, it allows us to attract and retain key investment talent like DJ for most of their career. And so we think that consistency of personnel hopefully leads to a consistency of philosophy and process that you value. Second area would be our business model. It's very simple at our firm. We solely focused on investing assets on behalf of our clients. We exist for that. Folks like DJ come in every day just myopically focused on how to generate alpha. People on my team come in and think about how can we take really good care of our clients. We know if either of those two things falter, our business is at risk. So you can rest assured that's an area of focus for us on a daily basis. And then lastly, and I lump these two things together, it's our investment model and our culture. They really go hand in hand. So there are people at Wellington that are like DJ that look across sectors. We also have global industry analysts who are sector specialists on the equity side of things. We think that model is different because people like DJ are super deep in the weeds and making investment decisions based on their own philosophy and process for your portfolio. But they also have the support of a broader ecosystem at Wellington of subject matter experts that they can lean on when they're analyzing different investment ideas as well. And these are folks that are really deep in their individual industries. And so we think that ecosystem effect, obviously we don't get every investment decision right, but the fact that DJ can rely on global industry analysts, he can rely on people on the credit side of things, he can talk to our macro strategists. We think that ecosystem and cross-pollination of ideas hopefully leads to a more robust investment decision on behalf of our clients in the end. And so I will pause there at the firm level and turn it over to DJ to jump in the portfolio.
Thank you very much, and it's great to see everybody again. So I am going to, I'm not going to speak to every slide in the deck. I will call out page numbers ahead of time, but I do want to echo Greg's lead-in in terms of, thank you for the ongoing trust and support you have for Wellington and for our team specifically. So I'm going to start on page 6, which is the core investment team. And so I've been at Wellington for 26 years and have only been a small cap investor working on this team. And so I started as a team analyst, and I took over lead portfolio management responsibilities in 2020. In addition to me, Paul Elia, who's been at Wellington for 8 years, and Jess Lebo-Costello, who's been at Wellington for 2.5 years, are team analysts that are dedicated to your portfolio. And over their tenure, their work has directly contributed to your portfolio's performance. In addition to the three of us, as Greg mentioned, we greatly rely on Wellington's broader resources. And so namely, that's the 52 global industry analysts that you see listed on the right. Their research is going to be more sector specific as opposed to small cap specific where we're focused. And so we rely on them for their sector expertise, but also for their best small cap recommendations. Turning to page 8 is our investment philosophy. I would remind you that this philosophy has been consistent through the life of our relationship with you. There's 3 tenets to the philosophy. First is we believe that a opportunistic investment approach benefits from different sources of alpha and therefore is less dependent on the underlying market environment. On page 9 is a chart that I think kind of brings this more to life. And so looking on page 9, the blue dots on this chart represent stocks in your portfolio. And as you can see, these are companies that range from deep value to high growth and just show the extent that our opportunistic approach really tries to take advantage of a wide, the widest opportunity set that we can. The result is that your portfolio, as shown by that, that orange circle, tends to look more core-like than anything over the years, and it is not really considered a growth or a value portfolio. Turning back to page 8 on the investment philosophy, the second tenet is that we believe that industries and companies run in cycles, and we find our investment opportunities by anticipating changes to these cycles and taking advantage of short-term stock mispricings to a company's longer-term profit cycle. And then last, we believe that a strong management team is the key driver of shareholder value creation. If you turn to page 10, this kind of highlights the process, I think, very well. Each of us spend a great deal of time interviewing company management teams, and in those conversations, we're evaluating them on their strategy, their ability to execute that strategy, their ability to allocate capital against that strategy, and then their compensation and the alignment with the company's performance. And that's shown on the left-hand side of the chart. Through these conversations and over the years, we have tended to find three types of management teams that have created shareholder value. Those would be rising stars, and these are listed on the top of the page. Those would be rising stars, and think of this as a relatively younger management team, doesn't have a lot of public company experience, and we're attracted to their growth strategy. Two would be agents of change, and this is a new management team that is brought into a company to turn around recent underperformance. And then last is proven leaders, and this would be a management team that's been at a company for an extended period of time and has consistently generated shareholder value. Each of these management teams are found in your portfolio at any one time, but it's not, we don't try to balance them a third, a third, a third. Instead, we're looking to identify and invest with the management teams that we expect can out-execute their peers. In the interest of time, I'm going to skip over pages 11 and 12, which is the portfolio investment process itself, but I'd remind you that this process has been consistent, through the life of our relationship. Turning to page 13 are the investment returns for your portfolio listed over historical periods on the top and then specific calendar years on the bottom. Starting at focusing your attention to the top of the page and the first column on the left, over the trailing 12 months ending in July, we've been fortunate to outperform our benchmark by 1.4 percentage points. Looking to the right of that, over longer periods of time, your portfolio has had both absolute positive performance on an annualized basis, that's the top line, as well as relative positive performance, and that's the third line. I do want to call out in terms of the trailing 12 months, kind of put that small cap performance in context. So if you see the Russell 2000, which is a proxy for the small cap market, was up 14.3% over the trailing 12 months. And if you look at that relative to longer annualized periods, that looks like a really great year and really strong performance. The month of July was up 10% in and of itself. And so there has been a fair amount of volatility in the small cap market over the last year. That's really been driven by macroeconomic factors such as inflation, employment growth, and Fed's monetary policy that has driven movements both up and down in the small cap market. We've been very fortunate, as I said, to have outperformed amidst that volatility. But as we think about going forward, we still think that the range of economic outcomes is wider than some of the market perceive. And so there still could be some of that market volatility. And I'm going to get to that at the end of the presentation. Turning to page 15, listed here are the drivers of your performance over the trailing 12 months ending in July. Starting at the top of the page, the light blue bars represent performance that is driven by individual stock selection. The dark blue bars representing performance driven by sector allocation. As I mentioned before, given that we are identifying and investing with individual management teams, security selection historically has been the primary driver of our performance. And as you can see, it was the primary driver of performance over the last 12 months. On the bottom part of the page, listed here are the top 5 relative contributors and top 5 relative detractors to the portfolio's performance. Starting on the left-hand side with the top relative contributors, as you can see from a sector perspective, it's been fairly diverse in terms of the contribution. I'd say the common thread amongst those 5 are the management teams that have executed their strategies well and has created shareholder value, over the last 12 months. So starting with Viper Energy, this is a company that owns oil mineral rights on land in which others drill. The company has been able to expand their portfolio over the last 12 months and therefore have increased their future profit potential. Stepstone Group is a private investment solutions provider, and they have benefited over the last year from strong fundraising within their private wealth as well as within some of their PE securities funds. And then Cytokinetics and Crinetics are two biotech companies in your portfolio that had favorable drug development over the last 12 months. Focusing on the top relative detractors, I would remind you that when a stock in your portfolio underperforms relative to our expectations, we take a step back and ask ourselves, is our original investment thesis valid but just delayed, or is it permanently impaired? And if it's valid but just delayed, we hold on to that position and in many times add to that position. And so Shoals Technology was one in the case, the top detractor from your performance that we continue to own and we have been adding to. On the other hand, if we determine that the investment thesis is impaired, we will eliminate that position in order to protect your portfolio from further downside. This was the case with both Double Verify and Maxion Solar. In the case of Double Verify, they are an advertising technology company whose revenue growth rate precipitously declined within the last 12 months. And as a team, we just lost confidence in terms of the management team's ability to reaccelerate that growth. Maxion Solar is a producer of residential solar panels. That industry, by and large, has been oversupplied over the last 12 months. And we lost confidence in Maxion's balance sheet's ability to withstand what we foresaw as a much longer down cycle for that industry. I also want to call out Supermicrocomputer, which is the asterisk name, which was the second largest detractor from performance over the last 12 months. And this was a stock that we didn't own. And historically, it's very rare to have a non-owned stock be such a large detractor from our performance. This is a company I've known for a long time. They essentially, they build servers. And I view this as a pretty low margin, highly competitive industry. And it's also a management team that I don't hold in the highest regard relative to others in the industry. What I missed was they have had very strong revenue growth and profit growth because they were able to build servers for generative AI applications. And so they saw strong demand for that product. And so I underestimated that. I was wrong. I also underestimated the extent to which the small cap community would buy the stock and really bid it up to valuation levels that I found to be too high for what is a relatively lower quality business. Turning to page 16, and listed here are the sector weightings for your portfolio at the end of July, which is depicted in the light blue bar. The dark blue bar is the sector weightings at the end of 2023. Starting on the left-hand side, which is our overweights, we remain overweight to industrials as we were at the beginning of the year, but that has come down a bit just as we've sold a handful of positions that reached our price targets. Our energy weighting has gone up a bit, and that was primarily from the relatively good performance of Viper Energy that I previously mentioned. And then last, I'd point out that we entered the year underweight consumer discretionary and now are modestly overweight at the end of July. And that was mainly through the purchase of two companies, one Goodyear, where we expect a new CEO to be an agent of change for the company's recent underperformance, and also the purchase of American Eagle, which is a apparel retailer where we foresee a favorable profit cycle just from better cost management at the company level. Focusing on the other end of the page in terms of where we're underweight, we entered the year underweight both infotech and healthcare. And that's primarily been driven by three industries: software within infotech, biotech, and then medical products on the healthcare side. And this has just been a situation where we haven't been able to find enough ideas in those industries where we think valuations are appropriate relative to the fundamental outlook. Instead, we find valuations have tended to be too high. On pages 17 and 18, 17 is the top 10 holdings of your portfolio at the end of July, And page 18 are some portfolio metrics at the end of July. The portfolio metrics are in line with what has been historical ranges. I would just call out two in particular. First, at the top of the page, the asset-weighted market cap still has a small cap footprint and is within the plus or minus 50% range that we target for your portfolio. And then two, under financial metrics in the first line in terms of the EPS growth, we've been encouraged by our ability to find favorable EPS growth relative to the benchmark for the portfolio, but without taking undue valuation risk, as you can see on the line below that, with our valuation a little bit below that of the benchmark. And so those are the slides I wanted to hit on, but finally, I just wanted to talk a little bit about the small cap market environment, kind of as we see it today, in our outlook going forward. And I think it's, as I mentioned before, there's been a fair amount of volatility in the small cap market. I think it's kind of instructive to just look at the recent past and what's driven that. And so if you look at the end of last year, as inflation started to cool and the Federal Reserve started to pivot from their monetary policy on a kind of having a tightening bias and pivoting from that, you saw the small cap markets move up 20% in the months of November and December. And that's a pretty strong move. The thought being that the potential for a recession was being lessened as the Fed pivoted from their tightening bias. As you looked at year-to-date 2024, from the start of the year to kind of middle of July, the Fed had yet to cut rates, and you were starting to see employment growth slow. And so the debate started to resurface, maybe there was the potential for a recession. In mid-July, we received some favorable economic data in terms of inflation and job growth, and so the market got very excited that the Fed was going to be able to engineer a soft landing, and you saw the small cap market move up 10% in a matter of a week. We quickly gave back that gain a couple weeks later when the Fed didn't cut, and so we were kind of right back to the starting place. And I think in short, what the market is saying and what makes sense is, the longer that short-term rates stay high, the greater risk of a recession or just economic growth slows more than expected. I think this was all but acknowledged last week by the Fed Chair Powell out at Jackson Hole, and so it sounds like a Fed cutting cycle will start in September. Not surprisingly, the small cap markets had a pretty good week last week, and so we're kind of on this. We're kind of going back and forth between this debate in terms of soft landing versus recession. When we talk to our companies, and we're not macroeconomists, and so we're not going to make a bet in your portfolio in terms of a recession versus soft landing. And when you talk to a lot of our economists internally, our experts, you get a range of opinions in terms of kind of where they expect the economy to go. I think we have a good view into the economy in terms of talking to the companies in your portfolio, and we've talked to pretty much all of them over the last month or so as they reported their Q2 earnings. And I think the message by and large was that it's still a choppy operating environment as they try to balance weakening demand with still high cost structures. And so as we are encouraged by the fact that rates should come down and that could be favorable for business confidence and consumer confidence, the real-time data is also showing that it is still pretty tough out there. And so we're taking a much more balanced view of the economy than the market is or has been at any one time, and think that the range of outcomes can still be wide, and therefore we can still see that volatility. As investors, what we're doing is really just doubling down on our investment philosophy, and that's identify the management teams where we have confidence in their strategy, and we think that they can execute in this choppy environment. And so while I would love to sit here today and say rates are coming down and the small cap markets are about to run, I just think it's too soon to say that. And so what I do have confidence in is that regardless of kind of what happens in the economy and the market, the companies in your portfolio, and specifically the management teams in your portfolio, should be able to add value for your portfolio over whatever the market does. And so I'm going to pause there in case there are any questions.
I just wanted to say I appreciate your, rational view on maybe things, aren't as great, and, there still are uncertainties, so I appreciate that point of view greatly. Gives me good confidence that there's, that you guys do have clarity, so that's all I have.
Questions, comments? Yes.
Just a couple. So you mentioned the discussion between soft landing and recession. And of course, you talked about interest rates, which reminded me of the yield curve, which remains inverted. So all that to say, any thought on maybe, and historically, the yield curve being inverted has been a predictor of a recession. Any thoughts, or has there been any conversation around maybe we had a mild recession a couple years ago? If I remember right, it wasn't that long ago where we had 2 consecutive negative quarters of GDP, which at least informally has been a definition of a recession. I know the formal bureau had a broader definition. Any thoughts on that? Yeah.
I think if you go by that traditional technical definition, we haven't. Our U.S. macroeconomist at Wellington, who just does phenomenal work, the way she's been framing it is we've had rolling recessions through different sectors. And so you haven't had a broad recession, but we've seen a recession within industrials. We've seen a recession within the consumer. We've seen a recession, obviously, with the financials and kind of what the banking industry went through. And so, so what that's done is it's brought down overall economic growth, but just not negative. And so the hope is now that you've had these sectors go through their own individual recessions, and as we bring overall rates down, we can start to then come out the other side. But it has been frustrating because I think you have a lot of market participants that have this traditional playbook for once the economy does go through a recession, then you can put risk on in the portfolio and that will determine where they invest, but you just haven't had that signal yet.
Yeah, no, I appreciate that. That's helpful. And as far as the management teams, and you may have covered this, but just generally, about how much time do you spend meeting with the management teams if you're thinking about taking on a company and adding it to our portfolio?
We spend a great deal. And so, as I mentioned, I've been doing this for 26 years and I've covered technology my whole career. And so I've met with a lot of these management teams year in and year out. Paul Elia has been at Wellington for 8 years, but he's been doing this for much longer and he covers cyclical. So he's been meeting with those teams year in and year out. So we have a knowledge base of the companies themselves. As we're thinking about an investment, that's when we would ramp up our touch points with the company. And so we're fortunate enough for a lot of these companies will travel to Boston and come to our offices to meet with us. And so we have the opportunity to sit down with them for an hour. Even better, we'll go visit them at their headquarters and not only get to meet with the CEO, CFO, but get to meet with that management layer below that. And so we're spending a fair amount of time because as you can see, our turnover is fairly low. And so we want these companies to be in the portfolio for some time and create value. And so spending enough time to due diligence is very important.
Thank you.
Other questions from board members? Callan? Okay, we thank you all for coming down and being here with us today and sharing with us about what's occurring in our portfolio, and looking forward to working with you still in the future. Thank you.
Same here. Thanks so much for your partnership. Thanks, everyone.
Thank you.
Thank you very much.
Thank you. See you too.
Thank you. Great seeing you.
Good.
How you doing? Good to see you.
They're from Minnesota, aren't you?
Found it in my pocket.
They're from Minnesota.
No, I'm kidding.
Boston.
Huh?
Boston. There is a group
I
from
don't know,
Minnesota.
the grocery store, the convenience store.
Yes, we one before them was from Minnesota.
Oh, okay, yeah.
You want this?
You see, Ed gonna make a investment presentation this afternoon.
Who's that now?
Huh?
Who?
A rebuttal.
I don't think so.
Here's his tier.
Just wanting to know if you were planning on making a presentation?
No, not on the investment.
Give a speech or? Okay.
You save it for tomorrow.
Charles, Go ahead, please, sir.
I just have one last item, and that's miscellaneous updates. The first one is some information about a fee credit program that JP Morgan has put in place, giving us about a 30% credit on, during our billing cycle. So all the details are there. We will qualify for that, so that's a good thing. Let's see, the other items are just, changes. You guys just met Greg. He is replacing Juliana Lucas, which replaced Zonder Grant, which he's greatly missed, by the way. But, and then the only other item is just some, changes at Bally Gifford. Nothing is, directly related to our portfolios, just, high-level partnership changes, so. And that is all I have.
Mr. Higgins, do you have anything else for the investment committee this afternoon?
No, sir, that's it.
Meetings begin at 10:30 in the morning.
10:30 in the morning, that's right.
Meetings will be at 10:30 in the morning. Adjourn the investment committee. Have a good afternoon.